All right, guys. I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have Suri Duddella. He's here to talk about market context and structure. Suri is a well-known patterns trader, a very good patterns trader. He's been on BMT twice before talking about patterns, and he also has what many would call the Bible of chart patterns. His book is called Trade Chart Patterns Like the Pros. And at the end of today's webinar, we will be giving away 5 autographed copies of that book as part of our BMT 3-year anniversary. Also want to quickly mention that we have 2 remaining webinars this month for our 3-year anniversary, and they are on Al Brooks' trading channels and Jack Schwager, the author, the legendary author of the Market Wizard series of books. And in both cases, we'll be giving away a bunch of autographed books on those webinars as well. All right, guys, so if you haven't already checked out Suri's prior presentation on BMT, you should definitely do that. As you guys have questions today, just type them into the questions box. And what we will do is every now and then, Suri is going to pause his presentation and try to answer the questions for that segment before he moves on to the rest of the presentation. Okay, guys, the webinar is being recorded. You can find the recording sometime tomorrow on BMT in the usual spot. And be sure to pay attention today because the questions at the end of the webinar for those 5 books will be based on the content covered today in the presentation. All right, guys, give me 1 second, and I'll be turning things over to Suri. Hang on.
See my screen okay? Hey Mike, can you see my screen okay?
Yeah, we can see it just fine.
Okay, fantastic. I guess I'm still hearing a little bit, Mike, but you said the echo, you said that when you are off, I won't hear it, correct?
Yeah, let's just make sure. Is anyone hearing an echo when Suri talks? Okay, I'm being told that the sound is good.
All right. Thank you. Thank you very much. Thanks for coming for my presentation on market context and its structure. Thank you, Big Mike, again for inviting me. I guess this is the 3rd time I'm presenting it. My name is Suri Duddella. I'm sure some of you already know. I actually have a website called suriknows.com. And I'm a primarily pattern trader. I've been trading patterns for the past, I've been trading for 16 years, but at least last 12 years, I am exclusively a trade patterns only. So what I thought I would do is that this particular topic of a market context is something of a bigger research, and it's the most essential part of a research more than the patterns or setups. In fact, I've been working on this for a really long time. And even for the presentation, I've been preparing for the couple of weeks because this is the first time I'm actually presenting the market, entire presentation on the market context and structure. So I thought that I was quite excited to show some of the things what I do. And I think this presentation is about like a 90-95 slides. I haven't seen it all of them yet. But then I also have I brought in my actual trading examples. Both these are all in real time, and I may have a couple of days-based charts too. But I'll show you. And at the end of the presentation, as Mike said, we will be giving away 5 autograph books. So they will be like a quizzes. So please pay a little bit attention to what I'm saying because most of the questions are from this presentation itself. So that way, we can actually answer it and we can win it. And I will, at the end of it, I will be also giving my email, and I'll show you some of the discounts for the book, how you can get it and all. And so that way you can actually see that too. So I'm hoping Mike and everybody can hear okay. So I will just go ahead and proceed. Mike, just say yes.
Yeah, we can hear you just fine.
Okay, fantastic, thanks. Okay, so so before I go further, please read my disclaimer. an advisor in any sense. I'm purely a private trader, and all the material I'm presenting it today is purely for educational purposes. And this is purely I want you guys to learn and see what I do. And also all the material is copyright protected. You don't need to record it yourself. Mike is already recording it, and this will be posted on the Big Mac's website in the next 1 or 2 days, maybe by tomorrow. So first I wanted to congratulate Mike and BMT for really bringing this on their 3rd anniversary of BMT. This is fantastic because I think BMT is really successful because the quality of the presentations, quality of the topics, which is fantastic. And we know that in the industry, many trading forums come and go. We have seen some of them die off because of their lack of interest, and then basically it just goes to different directions they go. But I think Mike has been really successful in bringing the technical side of it, and also the trader's perspectives of the trade. And I'm actually a silent reader. I go to BMT many times, and I've been reading lots of posts, and I do know how well it is written. So I think let's congratulate him on his 3rd anniversary.
Thank you very much.
So the first I thought I would do is I would present yes, thanks, Mike. Let's present an agenda. Agenda is what I thought I would do is I would give you just a brief thing of where is my type of analysis coming from, what type of a trader I am. Just briefly, just wanted to show you this trader type. The primary purpose is it actually says two things. First is it gives you kind of a template of how you wanted to know what type of a trader you are, especially if you're trading intraday. And the second is you also understand what type of trader I am, because I'm going to show you my trader profile. And then from there you understand why am I picking this type of a market context and why is it necessary for me to think that way. And then market context and the structure is the crux of the topic, and I will be presenting lots of my analysis, lots of tools which I have, and I will be showing you how they are used and how I actually used it to trade certain type of pattern setups. And then I'll go, the pattern context is actually part of market context, but I thought that it's a little bit separate topic because it deals with the patterns themselves. And then I move on to a topic, counter trend, because a lot of individual traders are there. Traders, a lot of them like to trade in a counter trend, and I think, I've traded counter trend, for the first few years of my thing, and I really used to think that I'm a great counter trend trader. But counter trend is actually most vicious. You may win 9 out of 10 trades, but the one particular trade which gets out of your hand, that takes all of your profits plus more. So I'm going to show you some of the methods what I use to avoid counter trend, and I also know 1 or 2 methods where I trade in a counter trend, how to trade them. But this is only for experienced traders. And then in the entire presentation, I'll be showing a lot of examples. I think some of you probably know that I have to apologize because basically I'll be drinking a little bit of water every time because for some reason I need to drink water while these presentations. I still haven't figured out why. And then, so let's just go on to the trader type. As I said, this is actually going to serve 2 different purposes. This is a small template. I'm sure you can add a lot more things to it. But what I think, what I want you to do, or if you have already, using some type of a trade log, and if you have already recorded your trades or anything, what I do is, this is what my way of, I go and analyze my own trades every 60 to 90 days time frame. And 60 to 90 days time frame, I take my trades from trade log, and I actually record every single trade what I trade, and I write it down, and I actually have reams and reams of data, which is I've been collecting it for the last probably 10 years, so, and I have lots of data. So what I do is I actually, so what I want you to do is, if you have already a trade log of last 60 to 90 days, or let's say suppose you do not have a trade log, then you can probably do it from Monday. And then, and then first thing is what you do is you wanted to categorize whether you have traded anything, whether it could be a scalp or a big trade, whether you have planned or you have not planned this trade. That's one thing, one type of category. And the second is, within that planned or not planned categories, you wanted to see what have you traded? Have you traded patterns or setups, or is it a scalp based on some kind of a volatility or some type of a momentum? How did you trade this? Or sometimes you ask people, and I've done this too, or I have no idea why I'm in a trade. So if you have anything like that, you can also mark it that way. And I consider a scalp trade is usually if it's a profit and loss, of a less than 2 years points. And I guess most of the presentation is for years. I know a lot of you do trade S&P E-minis. So let's say, this is just a general rule. You can probably do it, in a different way. If you have made or lost, 2 years points per contract, and I consider that as a scalp. There's a time definition too, but let's not go into that. And then you wanted to find out whether you have used a trend trade or a counter trend trade, because this is where it actually separates. You will actually boil down to and say, well, you have traded X number of trend trades and you have made this much of percent of them are you made money, whereas some of the counter trend trades are anything which you haven't made money. So that actually kind of shows you, what type of a trader you are and how you can probably correct it if you want to. And then compute win ratios in each category. And this is almost like a personal, but I can tell you that this is very essential for you to monitor it because if you do not have a great win ratio, short-term trading is a pretty expensive hobby. So you need to make sure you need to reevaluate. Is this right for you?
Hey, Suri, is it possible
so
for
now,
you
let
to?
Me just show you yes.
Hey, is it possible for you to increase the volume just a little bit on your microphone?
Okay, let me try this. Can you hear me okay, Mike?
Yeah.
Mike?
Is it possible
is it
to
good
go? Yeah,
okay,
I mean, even just a little bit louder if possible.
Okay, let me try this and see if I can actually go. I actually increased it on the sound side, and I also increased it on the mic too. How is it now? Mike,
it sounds about the same to me. I have a couple of people saying that it's hard to hear you.
Okay, so. Can you hear me now? Is this? Because I increased it on the mic, I increased it on the the taskbar, the sound check also there also increased it.
Okay.
Try to see where we can change
yeah,
it
sounds fine.
Is there anything in the GoToMeeting settings?
It sounds fine to me. I think that people, if people are having trouble, they may have to just wait for the recording because it sounds fine to me.
Okay. All right. Okay. I'll go back to, I guess, I tried my best here and I've increased it wherever I can. Hope you guys can hear me okay. Then I think I wanted to give you my trade profile. For just about a few years ago, I'm talking about like maybe 7-8 years ago or 6-7 years ago, I used to be purely a counter trend trader. And I used to really pride on thinking that I can trade counter trend trades. I was decently successful, but it's not. Once I realized what all the mistakes I was making in the counter trend trade, I have actually at least 5-6 slides to show you what counter trend is and how to avoid it. We'll be talking a little more detail, but I have succeeded in the last few years to completely move on to the trend side of the trade and trending. So now I'm a pretty much 80% trend trade. Still, I have this bad habit of trading once in a while these counter trend trades, and I'm completely trying to avoid it. But that's 10 to 15%. I still trade counter trend trades, and then I'm completely a pattern trader. I'll still achieve like 85% of the pattern trader. 10-15% of the time. Sometimes I get into this silly volatility trades, and they really don't work out very well. But I just still try to do that, and I think I'm trying to completely move to 100% pattern trader. And then one thing is for sure, I am actually greatly successful in reducing the scalp trades because patterns, when they are traded full extent, in fact, I'll show you a couple of examples of how I trade full extent of it, and they are like, because now you can write and tap, you can actually take the max profit out of the pattern rather than just taking, 1 or 2 points and then get out and, think that it's a big thing. But whereas I'm still trading some scalp trades, and I really wanted to reduce this. But it's not an easy thing, and once in a while I have no trade all day, and about 3:30 in the afternoon I see one trade and then say, okay, I'm going to trade a scalp. So that's the reason these become like 20-25% of it. But eventually, I wanted to get into the full 100% of the pattern trades. So from this profile, what you're going to do, so the idea is these are like almost like my goals, is to trade 100% of the patterns. And you could also come out with a goal and say, well, I want to trade X type of setup only, or I want to trade this type of trader, and avoid or reduce scalp trades. That's the biggest thing I'm working on. In fact, that is actually a lot of people really, if you want to be successful, you need to work on that, reducing the scalp trades. And also one of the very critical aspect of your performance reports must show you that your largest win to largest loss must be greater than 1. If you are dropping, if it's not above 1, that means you are not going to be successful in the long run. So that's what I constantly look for it. Did I lose a lot of money, and did I make money, but if I lost a lot of it, then the ratio is less than 1, and that's what I constantly look for. I actually analyze my performance on a weekly basis, monthly basis, and come back and then just to point out where all I'm making trading errors and why are they, and that's how you can improve it. You could have some kind of a mentors or something, and then probably maybe they may look at it and advise too. But I guess, and I have friends who are my own mentors, but I analyze myself and then I figure out where all the mistakes I'm making and how I can improve. This is the then I guess now let's get on to the market context. That is the prime part of this presentation. Market context is something which is absolutely every trader must follow, and every trader must know what it is. I'm pretty sure you are already right now using some type of a market context to analyze your trades. Whether, let's say, suppose if you would ask hey, whether is it a bullish trend or a bearish trend, and I'm sure some type of a you have an indicator to tell whether it's a bullish or bearish type of thing. And so that is the concept of the market context. But then but on the other hand, let me actually come up with and talk to you this particular topic is, if you were to ask you a simple question saying, hey, what is the best scenario for trading? Then you may come and say, well, I want to trade in the great trending markets. Like let's say suppose from October of 2011 until April, it was a fantastic trend market. If you're trading in a if you're trading on the upside, you will be making money because it's a great trending market. And also it had a pretty decent volatility, not excessive volatility, but decent volatility. And it's a calmer market. If you compare to last few days of markets, what was happening, they're not calmer markets. They're quite volatile. And then you also say, well, I wanted to use some type of a great setup or a perfect pattern or something. So if you look at these are the 4, I'm sure you can add a lot more. You probably want to see a lot more liquidity and probably some type of decent instruments to trade and that type of thing. But you could add many. But let's just say in this one, the first 3 topics are actually belongs to the market context, because that's where without any type of a market context, you will know how is it a trending market, whether you're using a volatile or a common markets kind of thing. Of course, the pattern and setup is it's actually a trading type. So now, so it's basically the definition. See that it's a criteria to read the market. How you will say that I'm using a 50 period or 200 period moving average and say if the price is above it, then you say, well, it's a bullish market. And it's like a point of reference for you. And some things that it's like a roadmap. Where the price has been and where the price is headed to. Because we are all chartists. We are reading charts and that's what is finding it. But this is the most critical aspect. The context is absolutely everything. In fact, it's more than the pattern setup. In fact, I spend more time, in fact, a lot of traders spend more time figuring it out the market context than the pattern or setup. Because once the pattern is formed, there's nothing to look at it. Once you're into the trade, now you're worried about the market. How is it behaving from then onwards? One of the essential point is I never trade the market context by itself. That means I'm not trading moving averages or key pivots and resistance lines. I'm trading patterns. That is my way of looking at it. And then I trade patterns and which fits into the market context, which agrees with it, and then I take the trade in the direction of the market context. So usual context tools, people use the 50 period, 200 period, and then if you're an option here, if you trade up based on option theory, then you're looking at the market profile, like a point of contact, or a value area high, low type of thing. And a lot of people use pivots, and I use them too. And or if you're oscillator based, then you look at market and say, well, it's oversold and overbought. And those are the typical tools. But
so
let me show you what other.
Let me ask you. We have a couple of questions about context. So. Context is let me ask: do you believe context is subjective and is going to be different for every single trader out there?
Absolutely, absolutely. That is 100% right, because every person has their own tools and every person thinks, because I think, 21 period and 200 period is great, let's say. And somebody says, no, I don't care for them. I can trade 89 period and that's all I wanted. And some people say, I don't believe in flow trade pivots, but I trade opening range pivots or something like that. So people will have a different type of things to trade it within. Absolutely, they will have a different context.
Okay, so I mean, context is based not only on the time frame that you're looking at, but also the type of trader that you are, right? Because
absolutely,
yeah, if you're inherently a trend trader, or if you're inherently a counter trend trader, or if you're inherently a scalper or inherently a swing trader, context is going to be completely different for everybody.
Absolutely, I agree that without a doubt. So that's the reason I wanted to show what type of context tools I use it, and these are the probably necessary elements which I wanted to use it. And somebody, as you said, somebody could be using totally different type of thing, but you could. That's absolutely it's very subjective to individuals, so, and what really you think that is the best. Yes.
And let me ask you. I believe that you said that you define yourself as a trend trader, and you're primarily a scalper. Am I right?
No, I'm not a primary scalper. I'm actually moving away from scalper. I used to be extensively a scalper more. Now I trade patterns, full setups. That means when a pattern, let's say an ABC or head and shoulder patterns, which I'll be showing you in the next few slides, is I'm trading the entire extent of the patterns. It's saying that, okay, I'm going to trade all that instead of taking 2 points and then wait for the next pattern to emerge.
Okay, so you would define yourself as a trend trader, but you're still a day trader, but not a scalper. Am I right?
Right. Okay, in my trading, there's two types of things I do. The S&P futures, which I trade, S&P futures or NASDAQ futures, the E-minis, I trade them purely from intraday only. And because I do not want to take the overnight risk, I never, in the last probably like 5-6 years, I've never taken it. But I also trade stocks and options, and I do not day trade them. I only trade them using purely from a swing perspective. For example, right now I have positions all the way, like the option positions, all the way until April of 2013. And so even when I was taking right in October or November timeframe the options calls, I was taking positions for June, July of 2012. So when I'm trading options, I'm a little longer term. The stocks I actually hold any day from 1 day to probably 3 weeks, 4 weeks type of thing. So within that also I'm a pattern. I'm basically a swing trader only in options. But when I'm trading the intraday futures, I'm purely a day trader. But within that I trade entire the pattern potential, whatever it can reach it, and that's what I'll be showing you examples to.
Okay. Yes,
okay.
Thank you.
Okay, fantastic. So now let's move on to the market context consists of. These are my tools, and I will be showing you a couple of them. Well, but even when you are trading, what you need, the first primary thing what you need is you need to know the trend direction. The trend direction is the two types. One is the trading instrument direction itself, within that time frame, if you're trading 5 minutes or a daily or a 1220 tick chart, you need to know what is the trend direction within that. And the second is, which is nothing to do with that particular instrument, but we wanted to know what's the general market trend is. It's called market internals direction. Because we know that market internals are absolutely crucial for any trader's success. If you're not following market internals, because they win like 99% of the time. It's like a gravity, gravity always wins. So like market internals always wins. Because of that reason, you need to follow the market internals. The second is the price structure. So some of the tools I use it, I posted it here, is 21 period EMA, 89 period EMA, and 200 period SMA kind of thing. So I watch them to see whether the price is above or below, or whether the pattern is, how is it behaving. In fact, I'll give you a couple of examples just to show you how I use them. And then pivots, a lot of people use the floor pivots. Of course, I also use it. But the fib zone pivots, Globex pivots is the two other big components which I use it. And these are, as I said, I do not trade any type of a moving averages. I do not trade pivots. I'm trading patterns, and then I'm looking at this pattern structure. How is it behaving with these pivots? And then the fib bands, and I built it, and actually I wrote this also in my book, so you can actually see how is it built. And there's a little bit changed now, but that's one of the things. And I use the price profile too, but I use price profile from not from the auction theory perspective, which is like looking at the whether what type of profile it formed. Instead, I use the point of contact, value area high, value area low, as a purely support and resistance. And I also use the gaps as one of the things. I have a gap fibs tool. In that, I actually see.
Sorry, when you paused, I thought you were done. A couple of more questions, if you don't mind.
Okay.
So again, correct me if I'm wrong, but you're primarily trading equities, not futures?
No, I'm trading futures intraday only, and equities. Okay. I do not day trade equities or options intraday. I always trade options and stocks purely from a swing perspective.
Okay, so then let me ask. This comes up a lot, so I wanted to get your input. Do you use 24-hour pivots, or do you use cash, RTH session only for your pivots?
Fantastic question. Well, if you look at the floor pivots are only defined for the trading, the regular trading hours, which is 9:30 and 4:15 East Coast time. And then fib zone pivots is pretty much the same. They are designed for actual trading. And the Globex, it says Globex is nothing to do with the real time. It's trading from 4:30 in the afternoon for the ES to next day morning until the next day morning. Market opens at 9:30, so it's completely Globex is entirely that perspective.
Okay. And last question for me on this slide. I see that you're using EMAs and SMAs a lot, and as I'm sure that you are quite aware, those values will change based on the size of chart that you're charting. Absolutely. So a lot of people. There's always a discussion, right, as to what is the superior, if there is such a thing, moving average. And some people like to say that they like VWAP, volume weighted average price, because it's consistent, across time frames. So just asking for what is your opinion? Why do you use something that's not VWAP?
Okay. I do use it. I also have a VWAP in my charts, and I guess I didn't put it in there. But the idea is VWAP is basically it actually starts picking up its values from. It doesn't pick up right 9:30, but as the day progresses, then you need a VWAP kind of a tool. But what I'm using is these 200 period, 89 period is purely not from a trading point. Like I'm not going to trade these EMAs or SMA or even the VWAP. I'm only purely trading if the pattern, let's say suppose if it comes and stops there, or let's say if my targets are near these 200 period or the VWAP, then I'm using some type of confluence of that, and then I'm taking the trade. So, for me, people can use, some people say 13 period EMA or 7 period, or, like there's many people use different types of EMA type of thing. And it's not, it actually, what is that, you think are right. And there is no such thing as this is absolutely right. Because I can say that 89 period EMA works all the time. Well, maybe it's not true. Somebody would say that, no, I think, like 81 period works. It's up to them, I think, individually what they can do and what is their, time frame or what, because I use a certain time frames, and that's the only time frame these things work.
Well, I think you said what might be considered the magic word, which is confluence, right? Confluence across whether it's multiple time frames or just different types of methodologies, because that's something that I've noticed. Personally, I'm not a fib guy. But I notice all the time, a lot of people are, and they'll post charts, right? And then we'll see, a 61.8 or a 76.3 or whatever it is, and it will align, almost perfectly, like to a value area high or a point of control.
It does happen many times, and that's the reason you just look for a confluence. As I said, I never trade it. That's one of the biggest things is I do not trade price levels. I trade patterns, and patterns what they're suggesting, and if they are confluencing with something, and let's say suppose I'll be giving you an example of where my trade was precisely aligned with certain type of a fib zone pivot or a flow trader pivot, and then I say, well, there is a confluence, and that's where I need to get out, and that's my target, and that's how I trade it. Okay, Mike?
Okay, yeah.
All right, I guess I'll move on to the next one. I guess in this, the gaps is something, and I use it, and also pattern context is, this is part of the actually market context, but pattern context is, I wanted to show patterns, how they are part of the pattern is probably part of it another pattern. So now we wanted to look at from the patterns from that particular pattern context. So I'll be showing you a couple of slides on that. And then the market pace is very critical, because when we are trading it, most traders actually lose money, even though they are right in their direction, even though they are right in the trade setup. But then if it's taking a longer time for it to happen, especially if you're using the tick charts during the lunch hour, imagine that tick charts like 1220 tick chart as an example, it really takes like 25-30 seconds to plot, from 9:30 to 10 o'clock, but then all of a sudden during the lunchtime it goes to 6 to 8 minutes. So because of that anxiety, what it gets to people, they'd say, well, and then obviously, it's reversing in that direction because it's slower market. So we need to detect, what type of a bar times it's plotting it, and the strength of the bar is there. And I actually published an article on this topic. You may be able to see this part of it on my website, and it's also, I guess, there in the Stocks and Commodities magazine too. And volatility is very critical, and I have ways to detect volatility, and I'll be showing you a couple of examples of how I detect it and what do they do, what is the volatility is used for. And then market context provides is basically, this is the slide we were talking about before, is it provides for me a confirmation for patterns price action. So in the red bottom, I say that never trade market context by itself. Some people may be trading by itself, but if you think that's your mode of trading, that's great. But for me, I don't trade market context by itself, but I use it exclusively, and I spend a lot more time than actually analyzing the pattern in the market context. So I look for the confluence areas with the pattern levels, and so these are kind of, it gives me what are the potential reversal zones, when I'm using the trade setup, and then I say, okay, and then of course there's the trend direction, you'll find it too. Another component is the market volatility and market pace. So we will actually work through these some of them. So first I thought what I would do is I would show you an example of one of my trade which is recent. This is from June 19th. If you look at the time, of course it's captured later in the end of the market, but if you look at it, this is one I traded. It has no indicators, no market context, just purely a trade information. So here, how do we know that? What did I do? How did I, even take in a trade at that 9:30 or 9:35 in the morning? Why did I take it, right? So by just looking at it, we don't know. But let's say, suppose if you go to the next slide, and I'll show it here. Here what I have is the tools which I use it here is called a fib zone pivots. The fib zone pivots is basically, it computes a pivot like a regular pivot, and then it also takes yesterday's range, and then it says, okay, 50% of the range, it adds to the pivot and plots it at one line, and then it takes 62% of yesterday range and plots it. Mike, I was going to ask you, can you actually see my pen, let's say here. I wanted to show this. So this is the, okay, so this is 100% of a range which is plotted above the pivot. I think the pivot is probably bottom here, pivot is here, and then what we're doing is we're actually calculating the 50%, 62% and 100%, and the next fib band is actually plotted at 138 to 162%. So when I'm trading it, what it does is it basically in the morning, it plots just one single time for the entire day. It only plots it, and then when I'm looking at the markets, I'm looking at it and saying, well, where is the market can go? What is the max range it can go? Where is the max low it can go? So basically, it plots a zone. It's called a fib band. It's like not fib band, fib zone pivots. And in this zone, I'm saying, well, if market is going to run today, if everything is working great, this is probably the potential max it can go. But remember, I'm not trading these, just the fib zones itself. I must have another reason to trade. So, and also, if it is the low side, then I'll be looking at this probably doesn't show it, but I may have another chart to show. Then it shows the low side where it can go. So.
And could you?
So this is
I missed the definition of what those fib zones were. It's based on yesterday's range.
Yes. Okay. It's actually, Mike. It is published in my book, all the formulas, and all you can see it also. It's basically what we compute a pivot, and then we say 50% of its range, and 50% of the range, and 50% of yesterday's range, and that's the first range, and then 62. So the band is constructed between 50 and 62. And the next is the 100% of the range from yesterday. So from here to here, this is the range. This is the range of yesterday's range. That's from yesterday's high minus low. And then from here, this is published at, the next level is 138 and 162. You could plot this forever, but that's all we needed. Most of the time, that itself actually meets the market may reach almost a 2 standard deviation of the level. But this is so these are the levels which I'm monitoring. Okay, Mike, go ahead.
And just to clarify, because I see a lot of questions coming in, like always. So there's nothing magical about these indicators. You have them on your website. They're available for TradeStation, but anyone can code these for whatever platform they want.
Absolutely.
You're pretty much giving the okay.
Yes, without a doubt. And in fact, I'll just give you just a brief history of it. So the pivots and patterns are basically, I use the flow trader pivots, Fib zones and Globex pivots. You can write them yourself, and I guess I also have indicators for TradeStation. And the key values in it is, the order of priority in this is something like this. First order of priority is always where is the previous high, low, close, and Globex high and Globex low. These are the critical elements because these are traded values. The derived values is, from these values we computed saying, this is the pivot, and this you basically take a low, high, close, and divide it by 3 and then say, okay, that's the one. S1 you calculate, a support 1, resistance 1 type of thing. And Fib zone pivots are a range values. That means it's also computed, but that's how they're computed as I showed you. So look for it. What I do is when I look for patterns, when I look for the pivots, I'm looking for the patterns whether they're beginning or whether they're ending within the pivots. And then how is it confluenced with the pattern target zones within the key pivots. So let me actually move on to the next slide and show you this is a little more detail. And actually I just want to give you a brief description of how is it actually got started. There is a book called, I guess, a high probability setups for commodities or something, the title I don't know, but it's by H.T. Jackson, and he's the one first time I've ever seen this concept of what he did was he took the yesterday's range, that yesterday's value, the traded values like high, low, close, and then he used open, high, low, close, and then he used the statistical analysis of every day for the past X number of days, and he wanted to know if he can predict where the market would open. That means there's multiple possibilities of zones. He's the one who constructed these zones, and then he said, well, where could be the open tomorrow, and that was his goal. And then after that, Robert Krause actually took the same concept, and then he actually a little bit elaborated and said, well, can I really find high and low type of thing? And of course, if you read any of those books, you will know more about it. But then, when I first got started in 2002, 2003, into the futures, that was my first entry into the Fib zone pivots. At that time, myself and a friend of mine, we thought we wanted to find out and do an analysis of and see if we can find something else. Basically, what we did, we know yesterday's high, yesterday's close, and yesterday's low. And then we also know, let's say, at the end of the first hour, we know how it traded, how it opened today, and what is the first hour high and what's the first hour low. So we have about 7-8 pieces of information that. So now we use that, and we wanted to actually find out, can we predict what's the close going to be by the end of the today? So that way we can trade in that perspective. So of course, we built this on a SQL server, and then we wrote lots of scripts, lots of analysis of this, and then about 6-7 months, we finally figured out that there's absolutely no way you can predict the close because it's too arbitrary. So, but then we said, okay, that's great. Even that itself is a great information that we cannot predict what's the close going to be based on what information we know. But during the process of it, because we had to write a lot of tests of, whether it's going to test Globex high, Globex low, what's happening within that range, then we figured out that there is a lot more actually nuggets came from it. So a lot more trading tips, what happens if the price actually trades at Globex low. And then how would you trade it? So we found a lot of formulas from that and saying, okay, we can trade this. Of course, we cannot predict declose. So the project itself is a bust, but it's okay because we know that. And then we started, we said, okay, whatever information we got we're going to use it to trade it, just during the intraday. So here is again the same thing. Yes, Mike, go ahead.
I guess you can tell when I turn my microphone on. A couple of questions from
yes, that's right.
A couple of people are asking, why are you using 138 or 38.2 instead of 27? I find that interesting. I didn't even know that 27 was a retracement, but I have more than one person asking.
Right, right. It just, I guess, you could, but basically 127 and, 162, the range is pretty large range compared, because what we are looking for a shorter range of it. I could use like a 150 and 162 kind of a 50 and 62, but this is my own preference of it. 138 is also part of the fib number series, and it's like a 38% type of series. So that's what I'm using it. We have tried it, I think 127, but then we thought that maybe 128 to 162 is a little larger range for a band to construct it, and that's the reason we just started using.
Okay, so there's nothing magical about the number. It's just something that you
No, it's basically we're trying to reduce the bandwidth. So from 38 to 62 rather than using it from 27 to 62.
Okay, thanks.
Okay. And then, so this is again, I did this research and like in probably 2002, 2003. Since then, I've been using it. I constructed this once at a time. I might have changed a few things here and there, but most of it is pretty much the same code which I wrote it in 2003. So here what we have is, this is the pivot, and here you can see all of them. So every day, the first thing in the morning, and it's use it on the ESD, and I plot it on 5 minutes or 30 minutes, so it doesn't matter what it is, because it's taking yesterday's range and it plots it. So it plots like, this is the pivot, and then this is the first band is 50 to 62, 138 to 162 is the next band. And if you look at the low side, it's the same 50 to 62, 138 to 162 at the low side. So when we are looking for the markets to sell off and go rally, we are looking for, like for example, here, if you look at it, this is the range it traded in yesterday's about 2 o'clock time frame. And then it actually provides like a resistance or support. But as I said, I never trade these levels. I always trade the patterns, right? So now let's see what happened here. So this is actually pattern formation of the ABC bullish pattern, which is forming on 6/19. If you look at the time here, most of my charts will have timestamps on it, so that way you'll know. And you could actually go into Twitter or a stock trades, or you go to my website, because I post these charts in real time. So when I post them, they're actually chronologically updated into Twitter and stock tweets. So that's how it is. So if you look at what happened was the overnight, this is most of the trading on this. It's actually happened overnight. Basically, before 9:30, this pattern was completed, because most of the time ABCs, the way how I'm trading is I'm trading from the EL level to, first is I trade to 62%, and the second I trade is 100%. And about 90% of the time, I'm never in the market beyond 100%, because I think that's it, and I probably cashed it pretty well in there, and that's it. So, but what happens is there is at least 25 to 30% of ABCs go much more beyond 127, 162, and they go all the way to 262. In fact, I've seen some go to 362, but they're difficult to trade it. But here, let's look at it, what's happening here. 9:30 in the morning when I come into trading, and I see that it's already traded. Of course, I didn't trade this because I was sleeping in the morning, and then said, okay, now let's see what's going to happen, right? So now I put this trade on this is the same on 6. It's about 9:40 time. If you look at it, and here what's happening is, of course, because of its ESD, we saw like a pretty big gap up, okay? And then second thing what we have is we have this fib zone pivots here, this range. So now it's actually price is trading, and I have an ABC pattern somewhere here. I mean, it may probably fall though. It's right here. So now I'm looking at it and saying it's actually gapped up. So usually gap up is the biggest sign that the market may continue to trend up. So I said, okay, my first trade, what I'm going to do is I'm actually going to trade this pattern and move this ABC will continue to, first is to see whether the targets of this, are they confluencing with any of these levels? Then I want to trade it up to that point. So now let's see this is the fib zone pivots. So here is what happened here. So this is the ABC which is continuing it, and this is where I started. I think my trade is like about 47 or 46.5, this area. And then now I was watching that this 227 and 262% is actually confluencing with the fib zone pivots here. This is the range. So then I said, okay, this is great. So that means my trade can be entered here about 9:30 and then traded with the first target is up to the 100% of the entire range of yesterday, And the second range is I wanted to get out before it actually hits it. That means I wanted to trade until here. Usually what I do is I don't, let's say suppose if 1356, let's see if we can delete this. It is, okay. If I see like 56.5, then I'm saying I wanted to trade up to like a 56 because I wanted to get out 1 or 2 ticks before. Usually these levels, it could go even higher, but usually these levels provide a pretty good resistance. So then I wanted to get out of it. So so I'm looking for the confluence of it. So I'm looking at this 227% confluence of the ABC target, 56.25, and it's coinciding with this. So I wanted to get out at 56. So these are the two targets. This is what I did. Now let's go back and revisit. So one of the things is all along, this is the combined market internals during that time. It's actually now, it's right from, of course, I don't use combined market internals in the first 30 to 45 minutes because the markets need to pick up, but it's actually continuing. It's showing me that the market internals are pretty strong. There's a gap up day, and I have an ABC bullish pattern, and it's trading about about the first range of this fib zone. So then I said, that's the great pattern to trade it. So 1034, I just posted this. If you look at the timestamp here, it's up. It's still strongly up. And then I said, okay, great. Now let's go back and revisit this side. So if you look at it, the trade was ended right at about 9:30, 9:32 time frame. And my first target is at 51. If you look at it, 1351, because this is the 100% of the range. 100% of the range from the pivot, from this range to here, it's 100% of the range. So here I got out at like a few, half of it. And usually I trade between 6 and 12 contracts. If I'm 100% confident, and if I'm like really thinking that ABC there I'm putting at 12 contracts, but otherwise 6. The 6 and 12. The reason is sometimes I do twice at like a 2 target levels exits, and sometimes I do 3 targets. So both of them can work, and if I use a 2 contracts kind of thing. So I use the OCO orders kind of thing, and then I use basically to get out. And then what happened here is the second one is I got out right here. So I got out, and of course it's touched this, or it traded right above this one, but then it started falling. And in fact, at the end of the day, it actually fell a little bit further. So I think here is the 1351 range. So this is how I traded the first trade. So that's a little more description. The trade I actually wrote down there. This is the actual trade. I said, well, 1346 exit, and then how I use the stops. The stops is first I saw it, the lower side of the range is about 1343, and I said, okay, if it comes back and takes it, so it's my stop was 3 points here for all the contracts. If it fell through this zone, fib zone, then I don't need to be in the trade, and I have a loss and I get out. So then once it moved to the first target, 1350, and then I said, okay, I'm going to move my stop to break even. That's my entry, 1346. If you look at it. This is 1346, and then the next trade is I moved up to 1356, and that's when I got out. But it didn't come here easily because it's almost about 2:30 time frame, a 2 o'clock time frame. That's where I exit. But that's the only trade I traded, and that's it. So this is what I say that when you're trading patterns,
so
you trade.
Sorry. Okay, if I'm reading your chart correctly, your stop came within 1 point of getting hit, right?
Right after that, right after my exit, that's right after my entry. Absolutely,
okay.
It did.
So here's just a general question. So let's say that it actually did trade down and take you out, and then it turned around and continued on. What's your feeling at that point? How do you feel about that? What do you do?
I actually, in fact, I don't have it part of this presentation, but I do have trade examples where I go back into trade, because if I feel really strong about the particular trade, and if it took me out and if it got me back, then I would enter it exactly. In fact, at the end of the presentation, if you have time, I can go up and dig it up in my presentation. I just presented for MTA last week, and I'll show you in that how I traded one of them, exactly what you're saying. It took me out because of the volatility was quite excessive, and I got into a trade, and quick, like in the next 20-30 minutes it took me out. But then within the 10 minutes it came back, and I re-entered into the trade. That was one of the biggest trades I traded. I can show you that at the end of it.
And my next question is, I noticed that you're all in, so let me ask you why. Why do you go all in?
You mean just 6 contracts?
Right, I see you scaling out. Yeah, so you scale out, but you go all in. I'm just asking, why. I always like to ask this question so I can understand, other views of what
most of the times it's, people say that, scaling out is pretty simple because you know that you can see these two type of things. Scaling in is, something completely different. I really never mastered it. I thought I could do it, and at times I try to do it. I can do that in the equities very easily, but intraday futures I don't. In fact, other times it may happen is, I may be like, at a loss and then I'm taking it. But nowadays, I don't add to trades because that's not part of my plan. If I get lost, I get lost and I get out. So, I look for a comfortable losses like 3 or 4 points kind of thing, and, and a 6 points, and a 6 contract, 4 points is pretty large. It's 24 contracts and 24 points. And that itself is a pretty big loss. So because of that reason, I just exit out of it, and then if I do get an opportunity, I'll get in. Otherwise, I don't. In fact, very recently, in the recent years, I've never added to my own trades. I've definitely added to the equities and options positions because I truly believed in that particular setup. Because of whatever reason, of course, it was getting me out.
Okay, fair enough. And I have one question from Amy.
Okay.
When you say 100%, you're targeting 100% of the range. Just to clarify, you're talking about yesterday's range. Am I right?
Absolutely correct. Absolutely correct. And this itself, in fact, let me go back to that point. Yes, that's the one which I was targeting is 1351, right? 1351 is also this range here. This is the confluencing with that range. So this 162 AB, which is also confluencing with the same with the this is the fib zone 100% range 1351. Okay, and that is the 100% of the range from yesterday, and that's also it's like a confluencing with one of the pivot zone.
Okay, thanks.
Okay, that's the trade, and then I just want to show you a couple of more examples of it. This is actually from all the way from 2009. I was just trying to show you. So one of the things is, of course, not only that, I'm also using fib bands, and fib bands is to primarily see where, if the fib bands are also coinciding with my exits. Like this is the range. If I'm trading, 100 to 127%, are these actually coinciding? So I'm looking for some type of a confluence with the fib bands and fib zone pivots, and these are the tools which I use it. At the bottom there, like some kind of a trend tools. And then another, this is again from, this is actually from last year, August. This is, if you go to my website, intraday, you'll be seeing the first one of the few charts are all about the fib zone pivots. What am I thinking at that time? So I'm posting these charts so that way it's actually registers in my mind. And then you'll be seeing my pattern setups and how I entered it and how I'm actually waiting for it. So this is one of the ABC setup, which is happened at 811. I forgot whether I traded or not, but that's the target range. So this is also coinciding with that level. Okay, so I thought I would just briefly tell you about combined market internals. This is the tool I think I showed you. I actually plot this on a 5-minute chart, and then it's a small chart which is there on one of my monitors, and I'm constantly looking how are the internals are working. I truly believe it, and it's absolutely true. No trader will be ever successful without fully understanding market internals. As I said, market internals are like gravity. They always win. So you have to trade in the direction of the market internals. Okay. So the type of market internals, this is possible because basically there's lots of internals, lots of breadth indicators out there, but these are the ones which I use it, like advances, decliners, tick and trend, spiders and XLF, and ESI and X is nothing but it's a kind of premium index, or it's a premium, and this is the trade station uses a symbol called ESI and X. So if you were to plot it on a 5-minute chart, all of them are plotted on 5 minutes, and this is how the charts look like. Well, but can you decipher anything from here? I can't, because I can't tell whether decliners are going down or up, or then advances are showing. So this itself, if you're looking at something like this, it's incredibly confusing. So I spent actually a couple of years in finding out a single way of how I can represent all these 7 which I wanted to use it, and that's how I actually built an indicator called combined market internals, and it uses these underlying market directions, and it actually uses advances, decliners, tick and trend. XLF is the financials ETF, and the spiders, and because I really think spiders drive the market. ESI and X it's an arbitrage, and it's a I guess, premium index, and it's a purely an intraday indicator. It's not for a daily or a weekly chart, so you can plot it. And I plot it on a 5 minutes, and there is a 1 minute. It's called a CMI ribbon, but I won't really talk about that one. Just the CMI direction. So what I'm looking for it is when I am trading any pattern, not just ABCs or Gartleys or head and shoulders, I'm always looking to see, are the internals agreeing with my trade? That means if I'm in the trade, if I'm about to make a trade, and my internals must agree with the 5-minute CMI. And CMI also helps me find divergence, and I'll show you some charts like this. So this is up. So we took the 7 of those internals and built it into a single market internal chart. So this is how the internal chart look like. So let's say suppose this is the beginning of the day. So now I'm looking at for the first 30 to 45 minutes, what happens is that if you know that NYSE, not all the instruments have started trading it. So because of that reason, not all of them are quite stable yet. So about 30 minutes into it, then they start getting stable. If it's quite volatile, in fact, those days it actually starts trading right from the beginning. But but we don't know. So basically, I have a rule that I'll wait until 10 o'clock East Coast time to actually start figuring it out. So now it starts plotting. This is on a 5-minute chart. Always CMI, I call it on 5 minutes. I guess it's not there here. And then I'm watching to see whether, okay, if it's a green here, then I'm saying, okay, the trend is up, and then of course, the CMI is moving up. In this case, do I have a bullish pattern to trade? Or, let's say suppose the trend is down here, and then in this case, I'm trading, the base setups. If I do farm it, and if they do agree with the market context, and then that's how I'm trading it. So here is another one. If you guys, I actually wrote quite a bit about CMI on my blog called Trade Chart Patterns. You'll see some of the, I don't write very regularly, but when I get some of these things and I just write, so I clearly describe how I traded, what happened there, and that type of thing. So you can actually explain it. In fact, what Mike was talking about, one of the trade called a second chance trade. That means the first chance I got stopped out, and then after a few minutes I got a second chance trade. And I actually wrote about that particular trade. This happened in the last maybe 1 or 2 months, and I wrote this with lots of these charts on my blog, and you can actually see it. And CMI has some kind of so usually it never gets to these 150, 200 levels. So this line is actually 150 level, and then whenever it reaches that point, I'm actually kind of looking for reversals. It actually doesn't happen often because 150 is it's like, of course, some, whoever using oscillators, it's like almost like an overbought condition. So, but I'm actually looking for it, and this is how the chart at the bottom, what you guys seeing is the yes, how it's retrace. Just wanted to show you, and this is actually posted on June this month, 6th, I can. Okay, another one which I'm looking at is this again in March. I'm looking for some type of a divergence. I actually built some divergence indicators, but really they don't work for some reason. And so I said, well, I'll be using it. Basically, I'm kind of eyeballing it, saying, hey, this is what is happening. The price is happening. Usually, if this is the case, on a divergences, it doesn't matter what type of indicators you're using it. The indicator divergence is the priority over the price. That means the indicator divergence is going to win. That means that direction the price is going to lead. So that's how you need to think. Okay, I guess that's the first of it, and I'm actually going to show you my second trade. But I would like to see if anybody has questions, and I can take a question. Mike?
Yeah, there are a few here. Do you use any kind of oscillator? So you just go ahead.
Mike, one thing is it's almost an hour, and we are only probably 20-30 slides. This may go to 3-4 hours. The way he's going right now.
All right, we'll have to speed things up then. So one question is, do you use any oscillators? So you just answered that because you just showed an oscillator. Okay.
No, but that's not This is not based on a momentum indicator. Oscillators, the way how I look at it is oscillators are momentum derived indicators. I do not have anything momentum derived indicators. So I don't use oscillators in that sense of it. It's like a momentum bit like RSI or a MACD or a stochastics. Momentum by definition, they lag. And so if you're building a momentum indicator, then it's lag. So this is actually taking the prices of it, of the different instruments, and then they normalize using a formula basically, and then it looks at what type of arbitrage, the cash price and the futures price, what's happening with that, and that's how it decides, whether what's the value of the CMI. So it's not an oscillator per se, but I guess since I plotted at the histogram, it looks like an oscillator.
Okay. And do you provide the formula for CMI on the blog or in your book anywhere?
I'm sorry, I don't. It took me like 2 to 3 years to build it. I do not provide it. It's completely proprietary.
Okay. And just a couple questions for that I have in general. So you keep your.
Okay. Sure.
Do you ever take trades where you're risking more than your target? Do you have a negative risk reward or a bad R multiple?
You know what? I tell you what, we traders, the biggest thing is, we all go through these emotions, and so it depends on at a state. Let's say, why do I constantly ask myself this question: why do I take these 3 scalp trades? And because there is the risk reward ratio is usually 1 to 1, or even it's in fact, maybe you have a loss, even bigger loss than the reward. The reason what happens in most of the time trading is, let's say suppose if I'm trading and I have like 2 losses already, right? And then, probably nothing is working on that day, and in the market is trading sideways. So then, there is a tendency at the end of it, they say, well, I'm going to recover my loss, or I'm going to, I'm going to basically trade, oh, this is some scalp trade, I can make a 1 or 2 points profit. There's a volatility coming, because I know, I used to do this extensively when I was purely a scalp trader. So those habits still continue. I mean, those habits completely didn't die. So that's the one thing, that is one of my weakness in my trading, is I'm still trying to, come over that. But I have achieved now trading, 60 to 70% of my trades are full pattern trade potentials rather than trading scalps. So, my goal is to reach 100%. When those things happen, so when I see, like, let's say suppose if I have a pretty decent day and, I've been, when I see a scalp trading position, I won't take it, because I know that it's a scalp trade. I'm just going to stay away from it. Did I answer that?
Yeah, okay. And since you mentioned that you have so much of the presentation left, then I'll try to hold as many questions as we can, and maybe you can be selective on the slides that are left.
Okay. Well, actually, I think all of them are great, but let me go ahead and try it. Okay, there's another pattern is called, this is again using the fib zone pivots, but this is also used for a couple of other patterns, but I'll start showing you this chart. So what it is here, this is again on 6/20, this is just the last week trade, and this is on a Fed day, the 6/20th, they were going to come out with an earnings. So the night before, in fact, night before itself, I knew that this is the 6/19th day, 6/19th day, that's how the head and shoulder pattern was kind of forming there. So then I said, well, I don't want to trade during the Fed, the announcement. That means anytime after like 12 o'clock onwards, I really can't even trade it, because it's incredibly risky to trade. But I knew that there is a single pattern possible. There's a 1 trade possible today. I can trade it. If that doesn't work out, then I'm not going to trade anything on that day at all. So this is what I was seeing it, and this is like 9:34 in the morning. But this trade, see, if you look at it, the symbol is NQ.D. That means it's only the day portion of the trade, day portion of the chart. So then I was looking at this chart, and then I said, okay, I marked it here, and I said, well, if it ever trades below 2612, this neckline is 2612, and then I'm going to trade it. You can also see this is actually an ABC bearish pattern that's forming it here, right? So I said, well, I may be able to trade this trade, and then, so I waited in the morning. So then here, so right from morning 9:30 onwards, this head and shoulders never materialized. So it was all basically traded, and it didn't trade below, and then it traded above, and then it was coming like this. So about 11:15, I was thinking that, well, I guess it's not going to happen. And then I saw this, well, there's a head and shoulder pattern. This is the one, the marked with the green arrows. And then I also have something called a descending triangle. Descending triangles, usually fall, when they fall down, they fall really hard and then actually make trade. And of course, it also has the ABC bearish pattern. So I started looking and saying, well, I will only trade if it actually falls below this neckline, actually closes below a neckline. So I actually initiated a setup at 2611. Okay, this is the level, 2611, somewhere in this zone. And I waited for about at least like 2.5 hours, nothing happened. And then my targets would have been, if you look at it again, I'm using the fib zone pivots, and also I took the distance from the head distance, And then I said I was marking this and saying, well, if it ever happens, that's what I'm going to trade it. And you can go back and read this. I wrote this 11:17 and so come about 12:10, 12:09, 12:08 time frame. I saw, first thing what I saw is the massive volatility was dropping. That means it was ranging from here, was dropping, and I still have an order sitting right here. Okay? So, and I actually have the actual trade order. I'll show you how it worked in the real time. And then now my trade was hit at short 26 level, and then I would have actually exited if the price ever traded below 2 levels of it, 26.15, and if it ever comes back and trades above this right shoulder, I would have been out of this trade. That's about 26.28. And then my targets would have been about 26.04 and 2600. These are the ones. I was even thinking that since it's going to drop this way, I thought that it would even come all the way further and test this level of it. Okay? So here is the actual trade. This is the trade screen, and I usually plot it on 1 minute. So if you look at it, this is the NQ trade, and I traded 12 contracts. I traded right here at that point. This is where it actually fell. My trade was triggered right here. Okay? And my profit targets was showing here is right about 26.14 and then the 26.15. And then I even had 2 more targets all the way below this level. Like, as I said, I think like a 25.91, and these are the levels which I was looking for it to happen. So, but then of course the volatility was hit, and these things happened real fast. And there was a little bit of flag came, but usually flags are not easy to trade. So flag formed, and then it fell to this, my first target and second target. Within the next 2 minutes, actually within a minute, it hit my first target and the second target, and then quickly bounced back. Look at the bounce, what is happening within the fib zones itself. So I still have these orders out there. I still have my third and fourth levels of targets. I'm thinking that it's going to fall to 25.91 and 25.87 because it already took my 2 trades out. And then this is how it happened. When the trade came back, once it hit this fib zone pivots, it immediately started bouncing back. Then I had to quickly recover and actually take out these orders out, and then place an order just because I don't want, because it's such a massive volatility that it could actually bounce back and revert back to this trade. So I knew that this happens quite a few times, and then this is the reason so now I'm thinking it already reached this 100% of its head level. This is the 100% of this head level. Okay? If you look at it, this is 100%. If you see it, this is the range. So once it hit it, then I knew that, okay, then I'm going to cover it. So now I issued a market order to close my trade. So I got out about 26.10. So I got out somewhere here. And then so I closed completely out of my position. I came out as a winner because I got 2 targets are hit. My third and fourth target, I actually closed at the market. So it hit at 26.10. Basically, I got it just at 1 point. But other ones, I got it at 7 points and 10 points of NQ. If you look at it, what happened right after this. This is the final chart of that. Is basically, this is how it looked at, and this is how I got out of the trades, and I'll be explaining to you what these bars are in a second. And also, if you look at the volatility, see this volatility here, which is exceeding 50. Exceeding 50 means until here, it was below 0, you could trade the thing. But once, about 12:30 time frame, as I said, this is the Fed announcement was about to come, the volatility shot up. So when I'm trading it, I'm always making sure the volatility is below 50. If it is above 50, then I will not take new trades. I may be in the trade, I can be there, but I will not take new trades. But if it's above 100, even if I'm in a trade, I will be getting up. So this is the 100th level in the volatility. So, but luckily I'm already out of this trade, and then I said, okay, I'm done. Because it was a massively, the trend was coming. Because all day it actually traded entirely sideways. And then you see the quick volatility, how the volatility bars were showing it. And then once it traded at this level, it actually bounced back all the way to the next level of it. So I can point my pointer here. Okay, there. It went to the next fib zone, but I did not take this trade because since the volatility was above 50, I cannot trade it anymore. And I knew that about 2 o'clock, and of course the Fed announcement is going to come, so you might as well completely stay away. I don't want to be a hero and trading this higher volatility. I have traded foolishly when I was first started trading it, and they never work. You may win like 2 out of 10 times, but 8 out of 10 they'll kill you. So might as well just leave it. So that's how the trade was done. So I wanted to explain There are a couple of other ones. One thing is called a bar time. Especially this is good for the tick charts. When you're using a tick chart, because you don't know how much time it's taking for the for the bar to print it. Because in the slower markets, the bars may take, especially ES 1220, like especially in during the lunchtime, it may take like 6 to 8 to 10 minutes. So if you are in a trade, what happens is your anxiety builds it higher. So during that time, it's very difficult to be in the position. So you might say, well, I'm going to get out regardless of it. So bar time is some tool which actually I think it helps me significantly. So if the bar time is below 25 seconds for especially that chart, ES 1220, that means it's printing really fast. So during the higher volatility time, it's taking less than 20-25 seconds to print it really fast. You'll see this, right at the open, because it's printing for less than number of time. I have the pictures to show you. And then if it's anything about 150 seconds, that means if it's anything about 2.5 minutes, then I wanted to actually, it shows the slow trading, and I wanted to be cautious, and I also know that the anxiety kicks in, so I know myself, saying that, well, if it ever gets to 6 to 8 minutes, I'm probably going to push a button and say, sell off type of thing. So I know that kind of thing I'm going to wait for. So this type of a tool kind of helps. Basically, a slower trading is more dangerous than the faster trading. Faster trading, because it's happening faster, but slower trading is the one basically our psychology takes over us. And that's the reason it's more dangerous. And then traders are more anxious and make mistakes in slower trading environment. This is one of the typical charts I post, and it's there. You can see tons of times on my website. So here is the one, there is no trade or anything here. I was going to show you that the bar time is exiting. So what I do is I actually plot this on my charts, and it's only there on one chart, although I have like a 6 market setup, but just right there on my face. This is what I call, I plot all these pivot levels, and this is how it looks. And I know Mike was talking about it, and this is the VWAP. This is kind of a thick line here. You see the blue and the magenta. This is the VWAP line. So I'm looking for the confluences to see if my patterns are out of the market action is stopping or something like that for that. And then, so this is in the bar time. If you look at it, the white ones are basically, it's like, it's below 150 seconds. So anything about, once it starts ticking, like about 11:30 time frame, the price is going below 150, now 200, like that type of thing. And then these are the ones that's showing you that it's kind of slow trading. So this is how I actually use it, because since I trade 1220 tick charts, so if you trade, I guess if you trade the time charts, and because each bar takes a cent, so it doesn't matter. But if you trade any kind of a tick charts or the volume charts, this bar time kind of helps. And I'll be actually talking about this tool, kind of volatility tool, in the next couple of slides too. So here is another one. This is again on a day. This is actually Bernanke's testimony. In fact, on this day, I couldn't trade any of them, because if you look at it, the bar time was right at the open. It was taking 150 seconds. So now I know that it's going to take, and I know that he's going to speak on that day. This happened on 6/7. So entire day, I couldn't trade it, because it's basically, entire day until at least, 1 or 2 o'clock, it's basically, all the time was about 150 seconds. So then I said, well, this cannot be traded. So you wait for that to happen until he finishes his testimony and come out, and then see any pattern happens. Because if you randomly start taking trades, then of course obviously every single one of them will end up in a loss. So I'm always trying to see what's the bar time doing, what type of volatility I have, and do I have a pattern. I'm not trading volatility, I'm not trading bar time, I'm trading the patterns, and that's what I look for. Okay. And then I just want to talk briefly about the volatility zones, the one chart I showed you. Well, volatility primarily, it shows the risk in the markets. So, when we are looking at volatility, is basically traders are trying to avoid, heavy risk. We do want a certain volatility, but we don't want like this excessive volatility. So I actually plot this volatility on my charts, both on NQ or you can plot it at any time frame. But on my charts, what I'm looking for it is, I'm looking for it to see if it's above 50, it's a risky. So I have this voice alert set it for. So it would say that volatility is trading above 50. So it's constantly telling me that it's a risky trade to if you're going to initiate a new position. So I'll just say, okay, well, it's above 50, I can't take the trade. I'm just going to wait for it, even though I have a pattern set up and saying I'm not going to take a trade. If it's above 100, 150, even if I'm in a trade, I'm actually going to exit it. That means above 50, I will not initiate a new position. about 100 to 150, when it goes like that, those ranges, I will not take any trade. So even if when it gets 100, it says it's the extreme risk. That means get out of this trade type of thing. So here is the one. This is the another chart to show you that the volatility, particularly I guess it's again 613 day. It was just the entire day. It was all over it, all over this. It's above 50. So I said this entire range of above 50, I cannot trade it. This is how traders, especially counter trend traders, they'll be looking at the market and say, well, the trend is down, and then they will have some kind of a pivot or a VWAP or something here, and then say, oh, well, I'm going to get into the trade. Well, guess what? It actually will continues to get out because the volatility, and also it happens in a really quick time. So I'll be explaining to you what these bars are also probably in a few slides. Here is another one. This is the entire Fed day. This is, in fact, this is the trade. If you remember it, this is one of my trade again on 6/20th. Here it's basically once, pretty much I got out at somewhere in, I think, yeah, we saw the trade with the head and shoulder pattern. This is the head and shoulder pattern, and I got out somewhere in this area. From here, the volatility started picking up, and I didn't trade the entire day. There was nothing to trade because I just said, I'll just wait until tomorrow. Okay, so that's the concept of the market context, and now I'm actually getting into the pattern context. Mike, if you have any questions, I can quickly answer.
There's only a couple of questions, and they were asking.
Okay.
There was several slides back now, but why a 1220 tick chart or 1200 tick chart? Why not 1100? Okay. Why not 2000? Okay. Maybe you can answer that. And the second question is. You were showing a TradeStation chart for the NASDAQ, and it said 100 continuous contract. What exactly is that chart? It's a volume chart, but what size chart is that? It can't be 100 volume. That would be way too small.
No, I'm not sure what it is. Let me go back, and if anybody can spot it, let's just quickly look at it. NQ chart, right? You said NQ. Is it this one, 610? Oh, it's a NASDAQ 100. That's just the name of the contract. Name is, when you're trading NQ name is E-mini NASDAQ 100. It takes 100 stocks in NASDAQ and then it plots it. And that's the name of the contract. Is NQ is called E-mini NASDAQ 100.
Okay, so you just got you. I should have picked up on that. So you're using a continuous contract, but what size chart is that? Do you know?
Oh, that chart.
Is it a tick chart?
Oh, no. This, first of all, the fib zone pivots and all, you can plot on any number, but this is actually, I actually plot on 5-minute charts.
Okay. Okay. So that was a pretty stupid mistake for me not picking up on that. All right. And what about 1200?
That's right. But
is there any magic?
Okay, 1220. That's it. Right. Well, it's nothing magical, but what it is I trade a lot of fib members, and I trade a lot of these, fib, everything is, fib confluencing, fib ratios, fib bands, fib zone pivot, everything, a lot of it is fib based. So the number 610 is a fib number. So in ES, I used to trade 610 tick chart up until October of 2000, I'm thinking like 2009 or 2008, but in that, what happened was 610 is the one which I used to trade, and if you look at any charts, that's all I traded it. But what happened right in, I'm thinking it's 2008 October 12th, or 2009 October 12th, one of those dates, CME actually started unbundling the data. That means the unbundling is basically what they were doing is, before October 12th, what they would do is, if let's say suppose if at a single price, let's say 100 people came and bought, like let's say 100 contracts at a single price, then they would say that, well, the transaction is single transaction. They would report it as a one transaction happened at that price. So, and then of course, the data would come in as a single transaction. Well, after October 12th, after this, the regulations, what they did was they started unbundling the data. That means if there's 100 people bought it at the same price, they would report it as 100 contracts, 100 transactions. So because of that, the data actually doubled and tripled because the amount of data what is coming to your chart is actually increased. It's the same information, but the data points are increased. So now, in order to facilitate that double the data, then I went and said, well, I'm going to just and I actually went and calculated during that time for different instruments like the NQ and the ES, and then I figured out that it's roughly between 2 and 2.5 times. So I said, well, I took 610 and I multiplied by 2. That's 1220, and that's what I use it. And really this number at 1220 and 610, you could use any number out there, whatever you have it.
Right.
If you think that I know some of my friends say they would use a 233 tick chart, yes. And some people say 89 tick charts. I mean, that's incredibly fast. You will not be able to make it quicker decisions that fast. Humanly, it's not possible. Of course, the HFTs and they make much faster decisions, but we are not computers. So humanly, you will start making lots and lots of mistakes. Because of that reason, I say that. Okay.
Here's two good questions, and then we can move on. So. Bruce wants to know what's the formula for the volatility indicator?
This is again a proprietary, but what I say is volatility is there's many measures you can take it. One particular thing what I wanted to stress is do not think volatility like an oscillator. Volatility is like it's almost like a scalar. It just basically says, okay, well, this is the number. So in order to do that, in order to compute it, what we need to compute only the price ranges of it, and that's how I compute it. It's not based on any moving average or anything, because once you add that moving average component, then you're going to delay the moving volatility. So it's not that. But the formula itself is proprietary.
All right, and what happens when you get two different charts that have different patterns, opposing patterns?
Okay, very good question. But I tell you what, when it happens, the market context is the one which helps you, because as I said, I spend more time reading the market, using these context tools than the patterns. So maybe there's a dueling patterns which happen. It's very, very, very rare to see that two perfectly aligned patterns happening at the same time. What happens is that one of them is the only true. And if your market context is saying it's a bullish and there is a bullish pattern forming, I would take that bullish pattern rather than taking a bearish pattern, because your market context will be telling if it's a perfect pattern. Great market context is telling it's a bullish. That the pattern which is showing the bearish, that's false. So I would completely avoid that. Did I answer, Mike?
Yeah, it's fine.
Okay, fantastic. Let's go to the okay, pattern context. Pattern context is very critical. In fact, just the question whoever asked that is actually a very good question for this particular topic on pattern context, because patterns also need to be looked from the market context perspective. So there's lots of things in a pattern we really need to look for. The size of the pattern. Can you really trade 1 point ABCs, or can you really trade half a point head and shoulder patterns, or a Gartley's? They may form, but they cannot be traded because we cannot trade like a same smaller patterns. So the size is very critical, and the location is most critical, because location is the one which which is coming from this market context, or is it also part of a bigger pattern? So when you find out that, well, this is a part of a bigger pattern, so now let's use this confluence of these two patterns and then trade it in that perspective. And then, of course, in patterns, what happens is I'll be explaining some of these: uniformity and trend strength and integrity. That means when patterns are forming, it needs to uniformly respect some like a VWAP or a day high, or previous day high, or even the key pivot levels. These are if it's not respecting it, then you are seeing a bullish pattern, but it actually violated every one of them. That kind of tells you that this may not work. In fact, I have a couple of examples, and I'll be showing you that again with my trades, and I'll show you that also. And then integrity is in a bullish pattern. So especially bullish patterns will have, it's all the patterns are constructed using swings. Like, it may have an impulse swing and it may have a corrective swing. So in an impulsive swing, we should not be seeing, massive corrective moves to the downside, or massive moves which are forming with big down gaps. So those are the patterns when you're looking at it, well, this pattern may not be integrity. Or let's just suppose if you're looking at the corrective patterns, we should see down gaps. We should see like a wide range bars to the down because that's the corrective pattern. So that's how you need to think about it. So this is what builds something like quality of the pattern. And so all this is part of the market context, because when I'm reading the pattern, when you just show me a pattern, I say, well, okay, this is it. Is it, first of all, agreeing with the market context? And is the pattern well built? And then I would say, okay, maybe this is a great trade. Even then, there's no guarantee for the success, but at least you have a confidence in saying that this pattern is a quality pattern. It has a market context behind it. Because of that reason, I'm trading it. And that's how I think about it. And then, so I also look at the, the trends before the pattern, within the pattern, and after the pattern is, of course, you're in a trade. And then, actually, guys, give me 1 second. I need to fill my glass. I drank an entire glass already. Thank you. And then another one is the symmetry. Symmetry is, of course, you look for the both price and time. Some of the symmetric patterns are really wonderful to trade, and they're really great. So when I'm looking for that, and then I'm also looking to see, is this pattern actually embedded in some other pattern? And these 2 points, especially the embedded and the failure points, it's completely its own science. And I'm actually still working on lots and lots of this information. But, as I said, it's a trading is, you're constantly learning. I am constantly learning. I don't know if I will ever say there's a single day, oh, I'm done learning today. The day any trader thinks that you're not done learning, I think you should quit trading, because that's the day you'll start making bigger mistakes. Trading is a constant, it's an educational process. You always make mistakes and you correct it and come back. Okay, so I'll be showing you a couple of them. So let's start looking at this. This is actually on a chart from November 25th. This is where, this is the current, it's an S&P chart. And so this is what actually formed in an ABC pattern which was formed. So when we look at it, of course, this ABC pattern looks absolutely perfect. Of course, I have no other context on it, but let me start showing you the pattern context first. So what we see is the C actually retraces to 61.5. So this itself, in fact, at the same time, if you look at pretty much major sectors like the utilities, the technology, all of them are forming the same type of perfect ABCs for forming. So at this point, then I said, wow, this is great. If it's going to actually stop it, then that means, there's a possibility that, it may be reaching, these levels and these levels. So, but this is nothing to say that, this will happen, because, even next day it could fall below 61.5, it could go all the way to 1,000. It could happen. So there's nothing to tell, right? So, but now let's look at it from the next level. So what was happening was, at the same time, then this pattern actually has something called a harmonic ratio, which is coming from the previous. So if it is a 5-point pattern, this is the pattern context. We know that all the bullish patterns, bullish X5 patterns are like bullish Gartleys or bullish butterflies, will have an embedded bearish patterns. Whereas in this case, this pattern may be forming a 5-point pattern, like it could be a butterfly, it could be Gartley, but it has got a bullish pattern. So on November 25th, what I know is, while this is the part of the context, and it's also part of the X5 pattern. So now there's a possibility. Once I start trading about this year level, now I think it would actually get to these points. So this is what I was looking at and saying, wow, this is great. But at the same time, as I said, the multiple sectors were showing the similar ABCs. In addition to Dow, in addition to NASDAQ, all of them are showing similar pattern. So then I said, well, this doesn't happen that often, where lots of pattern confluence is forming. So now let's look at it, what would happen. So on the based on that, I actually took multiples of equity positions, as remember I was saying options, I was taking positions from June, July time frame, and said, well, it may happen, this 100% ranges, it will hit it. So that's the reason I was actually buying calls. I actually had like over 26 calls at the time, and I took all of them and said, well, I'm going to wait until June. And they were pretty cheap also, because the market was actually falling, right? So at this point, the options premium is very cheap. So now look at what happened. So once, on the November 30th, the first trigger was on the year level. Mind you, I'm not trading S&P by itself. I'm actually trading the instruments under it. So, but I thought that this would show you, because I could show the same chart for a bunch of equities, and like probably hundreds of equities during that time. So on November 30th, the first thing happened was the price first actually traded above. So what I look for in an ABC, so even here, I'm trading the ABC. I'm not trading this X5 pattern, but it is a part of an X5 pattern. An X5 pattern would have something like something like here. I'll show you a better chart like here. So that means any of these levels it could reach it. So now I'm saying, okay, it's forward to. So from here, this is on November 30th, I started buying options and said, okay, now let me wait for it. So in ABCs, let me see if I can delete this. Okay. When I in ABCs, not only the pattern actually projects the the price targets, but it also projects the time targets. So the time targets is based on the ABC cycle, because as I said, I'm only trading ABC here. So here is the trade, and then I knew that these are the potential possibilities, T1, T2, T3, and this is the entry, and this is the stop. This would be the stop if I were to purely trade that, but I just wanted to show you the context of the patterns, how they're traded. Okay, and this is by February 29th, it actually reached this 1376 from this level. Okay, and that's what I was saying, from November until April, the markets were fantastic. These are the trending markets, right? And on April 3rd, if you guys remember, that's the highest. It actually ever peaked on that day. Probably like about 14, 13 or whatever is the number. And that's the number. And while actually it was approaching, I knew that this would be actually, on the time cycles, I do not use the fib numbers. One more thing is, on the time cycles, I do not use intraday time cycles. I do not believe in intraday time cycles, but end of day or a daily time cycles are pretty perfect, and that's the reason I actually use to. So if I'm trading options, that's great, because I'm going to use a daily chart and then look for the the time projections for the time projections and using the daily time projections. And then if you look at it, this is the 3rd April, and 3rd April is the one which is actually market peaked. Okay, and this is actually current. This is how the chart looked. Of course, we all know that it fell all the way to 1250, and now it's bouncing back right here. Okay, but this is, of course, this is the one thing which differ from me and the traders who trade the butterfly and Gartley patterns. Because butterfly and Gartley patterns, what they do is they actually wait for this point to happen. Okay, based on the harmonic ratios, and then they start shorting it. And I call that is actually, they actually blindly they look at this point and say, well, we can short it. Well, many times, it probably think it works, but that is a counter trend trade, and I will not trade counter trend trades. And because, any point, this could have easily stopped right here. And then if you were to trade shorting here, and many people probably got killed. In fact, if you look at it, this is what happened in quite a few of these patterns, and that's the one thing I differ for me, is because I actually trade the internal pattern as using an ABC from here to here rather than trading there. Okay, so that's what it happened, and that's how it's a shaded pattern in trade session, and that's how the ABCs are plotted. So, well, that's the pattern, and of course I will be talking about the trade in the next seconds. Then, as it's all about pattern trends, I will be looking at prior trend before the formation of this ABC pattern. I'm looking at the prior trend. How is it forming within the trend, and then after the trend, which you're in a trade. That's where, of course, most anxiety and most worry is. Once you started trading it, what would happen? So on this basis, this particular tool is not completely built, but I'm still working on it, is to basically, I wanted to score, or I wanted to give us some type of a measurement saying, what is the trend within the pattern? What is the trend, outside the pattern, and how do you actually use it type of trades? So what I call it's a strong pattern structure, and you can go back and read this slide. But what I look for again, first is there should be, when I'm trading ABCs, I'm looking for the pattern context. Is it a part of a bigger pattern? And the second thing is, one thing is, of course, ABC, this is almost like a perfect ABC. When the pattern actually, what we need is we need to see a sell-off in the markets, and A needs to be outside the pivot, and B needs to be above the pivot, about the mid band. This is the fib band it's plotted, and C needs to be at least at 50%, but not more than 88%. Optimal is probably 62 to like close to 70%. Those are the best trades, and once it start trading above the EL levels, and that's my entry, and that's how you start trading it. Of course, this is what I call it a strong pattern structure. So this is one thing I wanted to mention is the integrity. The integrity, of course, I actually have quite a few other slides I post on it. Let's say, imagine this is the chart. This is actually Google's chart, and this is the Google chart, very recent actually, Google's chart. But here what was happening was, I posted this all the way from May onwards, what was happening in Google. If you look at it, this is in Google, this is an ABC pattern. ABC bearish. So what we need to see is in the AB leg, which is an impulse leg, in this leg what we are seeing is we need to see some type of a massive down bars or a massive, what I call is a down gaps. And that's what it's forming. So that itself is a critical sign. So once I started trading above this point, first I thought during probably a February, March time, well, actually Google starts falling right there. But it didn't happen. Of course, it came back, and then once it started correcting it, and then I realized that this is an ABC pattern. Well, in this leg, what we are seeing is, because it's a down leg, in the down leg, what we are seeing is it's a gap down. But well, on the another down leg, which is, this is actually your trade leg, again what we are seeing is a big down box. This itself is telling you that probably Google may be heading much further down. And that's what I'll be thinking about. When I'm using the patterns, I'm looking for something called an integrity. So look at this, this is the Google chart, and this is the EL. And this is what it tells that this pattern is the ABC bearish pattern, and these are the targets. Of course, Google is not there right now. Google is still trading about, I think still trading about like a 560 range, I believe. So it's now, but this is the target zone. This is the target zone, and of course, K-Trend, it's another trend tool which I use it, but probably we won't have that. So the integrity is very critical of the pattern cycle. So ABC with excessive noise. When I look at patterns, ABCs, what I'm looking for it is, is it a clean chart? Is it a clean trend? Or is it a, has a massive excessive noise? This is what eventually I will have a tool to kind of give something called a pattern trading index. As I said, I'm still writing this for the last year almost. It's still not complete because I'm still think it's not perfect. So this will tell me when ABC is forming, it will look at the previous trend, it will look at the trend within, and then says what's the index. So this index, I'm thinking like anything about like a 60 would be probably better traded. So that way it will give you an opportunity for you to trade it. But so when I look at these type of patterns, this type of a chart or this type of a retracement actually worry me the most, because if I see a smaller retracement like this is okay, this is a pullback. But if I see a pullback all the way down, this may worry me if I'm in a trade. I think this will come and take me out of my trade, because in this case, if I traded, I'm not sure if I did or not, but this won't have traded. This won't have taken me. But still, I'm saying that this type of choppiness is actually worries me, and that's the reason tools like the volatility bots kind of help me. So. I think that tool is going to be called something called a pattern analyzer. This will have an index called a PTI. PTI would have things like, it will actually talk about like the market context itself. As I said, it's still building. It'll start telling you, it's like what if you ask me whether a pattern is a great pattern or not, what would I be doing? So this is whatever I'm thinking I'm actually building in this tool. So it will start plotting it right next to the ABC, saying, okay, what was the market context, whether the trend was up or trend went down. So it's almost like me telling what would happen in this pattern, or what is the PTI, what's the short-term trading, what is a daily analysis type of thing. So this is what I'm still building it, but that's how the pattern analyzer will look like in future. So now, let me give you an example. This is actually, it's great that, because I actually had another example, but yesterday when I traded it, I actually found this pattern, and I thought this is a perfect fit, because if you look at the date, this is 6/22, this is yesterday's trade, okay? So, but I wanted to show you and see, there are two patterns, because I trade ES and I trade NQ, and NQ I trade in 610 tick chart, ES I trade 1220 tick chart. But in these two charts were presented to me, and then when I wanted to look at it, I started analyzing the market, and I started analyzing the pattern, and I wanted to see which one would I pick it. There's only one of them is great at that time. In fact, and by the end, both of them worked out, but at the time of my trade, I knew that I can only trade one, not the both, okay? So let me actually come out with that particular reason, how I picked that only one chart, not the both. And I will also show you how I traded it, okay? So what happened, okay, from these two charts, this is the one, which is the post. If you look at it, this is 1055. I said, this is what it triggered it. I knew that this is the best thing to trade at ABC rather than the NQ trade, okay? So I'll have a better example. So this is what I was trading it, and I'll show you the trade itself. EL was at 1321.75. It's fresh in my memory. I entered it at 1322, and then I had two different levels of target, and that's how I got out. Because as I said, it's at 10:55. Actually, just before 10:55, I actually got into the trade. So here is my analysis of it. So this is actually the chart, which may look like this one. So if you look at it, we'll also look at NQ, but I'll tell you the reason why I picked ES over NQ. Okay. I'm actually going to talk about these particular bars called volatility expansion bars. Okay? These are the bars which just plots it on the screen, right? So when I am trading the pattern, I'm looking for pattern, market context, pattern context, two things. The market context is telling me that when in this AB leg, there's one thing happened. It absolutely respected this magenta line, what we are saying, and I'm going to draw this magenta line. It actually absolutely respected. It's a 200 period moving average. So I knew that this leg, even though it had a basic retracement, and then it traded above this high, it tells me that this leg is actually pretty bullish leg. Okay. This is a bullish leg, and also what I'm seeing is I've only seen, like, two of these small bars, small volatility bars, which are actually in this leg. So it's not still like a negative momentum. If the price been trading below 200 period moving average and then trading further down, then I would have said that no, I cannot trade this pattern. But now let's go back and actually look at it. We'll come back to this chart, but let's go back to this NQ chart and look at it. What was happening here was the entire AB leg itself, almost entire AB leg was below 200 period moving average. And the second thing is this retracement itself is actually beyond 50% of it. So this tells me that this may be a bullish pattern, but I'm kind of a little bit doubtful because this leg is quite not up to me to say that it's a completely bullish trade. Okay, so now let's go back to this chart. There, let me remove it. These drawings are really ugly. And then, so once I entered the trade, but mind you, this is about like a 10:20, 10:30, and I'm thinking, well, I am definitely going to see these target zones, which is actually has a confluence with the Globex highs and also 62 to 79. Now, one another thing is on Fridays, I usually do not trade after like a lunchtime. So I might take one or two trades. Usually I'm not there in the market after 12 and just say that for some reason it's just I just get too tired by the end of the Friday, so I just try to leave out of the trade. So after I entered it, there was a massive chop was coming in. But still I said, well, I'm going to stick to it because I entered at 1322 and my stop was about 1320. That's about like that's like a 2-point stop loss. I said, well, okay, if it takes me out, let it take, and that would be the only trade I would do it. Right? And if you look at it, this too is called a bar time, right? And I definitely wanted to make sure that the price is not going above 150. And if you look at it, this is about 12:47, the lunchtime, and see these bars are printing about. That's when it is printing like a 150, 200 seconds type of thing. So that means it's kind of quite active. But if you look at the volatility here, it's completely safe volatility to trade it because it's far below 50. There was not a whole lot, even in this chart. If I would have done a decent pattern to trade it, it would have been fine because basically the volatility is still below 50. This is actually my trade. I guess there is a time. Yeah, it's about 144. I actually took the screenshot just before it hit my target. So this is what you'll see. This is my entry, 1322, if you see it. And this is my first target, and this is my second target, and then these are the stops I had it right below. It's about that level. And then, so this is what happened. Actually, the trade by 1:52 o'clock, I guess. I'm still in the trade. Look at the time box. It's printing incredibly high, and then it reached my first target was reached at 1326, and the next target was not too far from that, 1327. And these two both of them were hit on this one. And that after that, that was the end of my trade. In fact, and that's what it is there. Yesterday, actually, the high was 1327, and then this trade actually continued to go up all the way to I think it's 1331. I believe that's the high on that day. It went up, but by here, I actually got out of the trade, and I was completely out. And I saw that even the volatility was picking up, even at that time. So by then, I was lucky that I was completely out of the trade. and here. The funny thing is, even NQ also worked it. Okay, the NQ, if I would have traded the same NQ, it would have worked the same. But at that time of my analysis at 10:30 or a 10:40 time frame, at that time it wasn't a great trade. Well, it worked it after, it worked by 3 o'clock. By the end of the day, it did work. But that's that's after the fact. So I just wanted to show you that that's how it reached it. But of course, I was not in this trade at all. Okay? Mike, any other questions? I know it's 12:45. We will be doing this counter trade. This may be quick, and then we will probably go to the quiz and questions.
Right.
Mike,
Yeah.
Any questions?
No, I think we should skip and just try to go as fast as we can so we can get the rest of everything. We still have to do the quiz questions.
Okay, absolutely. We'll do it. Okay, I'll stop. Counter trend. This is what I did. This is my own code. Counter trend trading is more of an ego issue than trading skill. This is absolutely coming from my own experience, and I've seen it. I've seen traders present these counter trend techniques, and I did notice that it's actually coming from their ego. It's like imagine you are an intraday trader like me, and you get up in the morning and then you come to the trading desk at 9:30, and then you see market is gapping up 10 points. So what most of the traders are thinking that. They're not thinking that, well, it's going to go to the 10 points up, will go to 20 points. They're thinking that, oh, we will find some spots on it, and then we will short it, because that's kind of counter trend, right? So that's what that thinking itself is basically coming from ego. It's like almost me saying, well, let me show you how the market works, kind of thing. So it's an ego issue, and I worked on it, and I'm completely glad that I do not use that. I know I still do once in a while, especially at the end of the day, kind of trades. So, but I would say that limit that counter trend trades. So what I wanted to show you, I want to show you an example of it. This is on a May 4th, whatever it is. So this is how my charts look, and the market, of course, started tanking. Entire day it was started tanking. So in this day, if you're a scalp trader, you think that, oh well, there is an S2, and then you probably go and buy it here, right? But then you may not get in, you may not get out. Basically, you may get out with a loss, or you think that, well, there is a POC 7 here, and then let's go and buy it here. But you think that there's any stocks are coming, and that's the reason counter trends will kill you pretty much. Because as I said, 9 out of 10 times you may make money with a scalp, 0.5 to 2 points. Profit, but the time it actually takes you out of the trade, you will leave all of your trading rules, and you think that now you start praying, thinking that it's going to reverse it. It never happens. And in fact, on a big down days and big up days, it's actually very difficult to trade it. In fact, many institutional traders completely stay away because they say that they know what it is. You cannot obviously go and take a trade, but you cannot also short it because you think that, hey, it's a down day, let me go and short it. Well, that also is not a quality because you don't know when the market is going to reverse it. So because of that reason, I would actually I would completely avoid trading counter trend, and I have only 1 or 2 techniques how to trade it, but I'll start showing you in a second. But here is another one. This is actually January 21st. This is the day before yesterday, right? Market actually started tanking, completely tanking, and if you could have any number of levels, nothing would have worked. Any time you bought it, you would have been killed, pretty much, right? So what was happening is, I have all this tool, this is from my charts. What was happening was, of course, I have this fib bands plotted on the top. What I would be looking at is, well, is the price actually, one of the conditions for me to trade a counter trend trade is, I want the price to go and touch the mid fib band. The mid fib band is plotted in the red line here. So, and then it comes back and gives me a retracement, and if I see even a smaller ABC, I may trade it. Otherwise, I will not trade it. So usually this, I remember a few years ago, usually these days I'll be buying long and waiting for it and getting killed. But nowadays I'm so calm, I know that I cannot take any of these trades. As long as I know that this price is not bouncing, to the mid fib band and coming back and giving me a trade, I will not take it. And I have a 1 trade set up, and I wanted to show you. And this is also, I did not trade it. This is on January 21st, so this is just on Thursday. And that's what I call it, the counter trend trader's nightmare day. Okay. So counter trend is, what is the counter trend? I already explained it. How do traders trade? And I have actually a list of ways how traders trade. And I'll show you avoiding counter trend trades here. Counter trend reasons. Why do people trade counter trend reasons? I really think plain dumb. Plain dumb is basically, the reason is something like, oh, it went too far. It didn't go too far. It can go even farther, right? Or it's some type of a desperation. That means you are in a trade, which is going against you, and then you're adding more and more. So that's the reason I call it a plain dumb trade. And then, or you use some type of a price levels, like a high-low or a VWAP or a 200 SMA and say, well, I know it's going to bounce from VWAP. It will not, okay? I've seen it many times. It doesn't care for VWAP. And then oscillator base. You plot some silly oscillator out there and say, well, it's overbought or oversold conditions. Guess what? Oversold markets can be overbought and market can be oversold for months. So, forget about days. It doesn't matter. So these type of oscillators would not work. Or a pattern projected measured moves. So I'll be like, looking at some type of a confluence with some numbers and thinking that, oh, this is a measured move from this pattern. Well, I didn't trade the pattern in the trend, but let me go and trade the counter trend of it. And that is also very dumb. And so that may be another reason. One more reason is, people say, well, Biogen had a bad news, so let's go and short the leading stock in that one. So it's like short Amgen. Well, that's not a good enough reason to short Amgen. Amgen may be opposite of it. It's probably doing quite well. So, you don't really go and do this, news from some stock or some sector and say that I'm going to do this contrarian thinking. Or trade ahead of anticipated news. That means, you are kind of, formalizing it and thinking that this is what Bernanke is going to do. Or this is what, some news from this company is going to happen. And so you anticipate and you've actually taken a counter trend there. None of these, these are just the reasons which I listed it. I'm not saying that you guys use this, but this is what some of the reasons. In fact, I probably use it one or other one at least once in my trading career. Or divergence on indicators. Divergence is the whole science by itself. Why it works, why it doesn't work, and I could go and talk about that for an hour itself. So here is the one anatomy of a CT trade. This is actually again from the this is one from June 11th. That's the reason recently the market volatility was quite high. If you look at it, it actually gapped up like 14 points on that day. Okay, gapped up, but look at what happened on the day. Entire day it started falling. So when I came into trading desk, this is about 9:30 time frame. Now there was absolutely not even a single time it actually went and traded at about the Fibonacci. That's my clue that maybe there's a positive momentum coming into it. It never happened. So I can just completely relax. As long as that doesn't happen, I don't need to be in a trade. I don't need to trade every single day. So that's how I look at it, right? And then, so this is the one trade. This also I did not trade it, but I was just going to show you that's the only way it can be possible to trade it. So this is just a little bit enlarged. So what I do is, basically what I'm looking for it is some type of retracement. This is don't even trade this type of setups. If it's a counter trend moves, in fact, I would say completely avoid it. But if it happens, a setup looks something like this. What I want is I want the price to trade about the mid-fib band, okay, and then give me the retracement. So if I'm ever going to trade counter trend moves, I want to trade retracements, not the breakouts, not the breakdowns. That means if let's say suppose in a lot of traders may say, hey, once the price is down, it's now the trend is down. Why can't you short it here? That's called a breakdown, right? I tell you what, just because it broke down, it doesn't mean that it's going to reverse and go up, or it's going to reverse. It's going to trade in that direction for a long. Even that is also a risky trade. But what I want to do is I wanted some type of a confirmation, some type of a positive movement coming back, and it just trades it, and then it trades up to the, that point. So basically, if you ever trade counter trend trades, be quick and be short. Short means within a short time you get out. So avoiding counter trend is one of the things which traders make a lot of mistakes is trading the counter trend in the first hour because they think, well, it's a gap and I'm going to trade at the gap or something like that. So I actually have, these are my rules, and again they change from trader to trader. So first hour, avoid it. Lunch hour is the one which is actually anxiety kicks in more than your actual trade setup. You may be 100% right with the pattern, with your trade setup, with your trade execution, but anxiety kicks in because the lunch hour is the one which is taking, each bar takes 8 to 10 minutes, and then you're like staring at this, and then one point or other you say, hell with it, I'm going to push a button and get out of the trade, and that actually ends up in a loss. So do not trade those counter trend trades in the lunch hour. And also trading the price levels, I showed you tons of them. It's a useless way of it. You look for a confluence, you look for some reason to trade it. Okay, and avoiding is basically news and major events. I have voice alerts. I program trade session to show me the voice alerts from just before 10 o'clock, just before 10:30, 10 minutes before. I have a voice alert saying that, watch for reports at 10 a.m. Watch for reports at 10:30. Watch for reports. I don't have a lunch report because usually I don't want to trade it, but I have one for the oil market close, and I have one for a bond market close. So basically, these ones telling me 10 minutes before, just the alerts coming in at the end of the bar saying, just keep abreast of it. This is what is going to happen. So this may help you not trade counter trend. This may help you not take in even the regular trades. Or in a momentum moves. In a momentum jet, the movements happen all the time in the markets. Don't know how they trigger, and why trading those type of trades. And also one of the biggest reasons is never trade against the gap direction. Okay, that means if the gap is up and then of course the price is retracing it back into the gap, and then you think that it will go even further and fill the gap or something. So you are actually trading against the gap. Never trade against it. So if a gap is present, I have a strict rule of not trading against the gaps. As long as price is trading below mid-fib band, you can be completely relaxed. Do not take a long trade, because counter trend is actually going to hurt me for sure. So because of that reason, I'm just saying I'm just going to stay away. Once it comes back and touches and it gives me a retracement, and if I think that I can take that trade, because whatever reasons, if my CMI is showing positive, if volatility is below 50, then I say, okay, well, this may be something which I can take it. But if I ever take a counter trend trade, I am really, really short, and that is always a scalp. I'm never thinking that it's going to go and give me 10 points. It never does. One of the other trick I found it is if you're looking at a market now, the best thing is to not even be there. Okay, just to leave trading desk and go and do something else for an hour and then come back, because that actually I found it to be the best thing. I said, because if you're near the computers, because then you think that, oh well, you actually think that you're more smarter and you can actually take a counter trend trade. So because of that reason, just don't trade. And these are my rules. Again, if you can take any part of it or none, but I think that's how I think that counter trend should be avoided. Let me explain to you this volatility expansion bands. So expansion bars is basically they mark within the chart itself. They mark each of these bars actually have some type of a volatility is triggering, and then they show me that this particular bar is has a volatility bar. So when I'm looking at what I'm thinking is, well, if it is a downtrend, if I have a down pattern, what I need to do is I want to see the red bar. That means the volatility is happening on the downside. As long as it's happening, the red down bars, I'm not interested in taking an opposite trade. So that means if I'm going to take a trade anywhere in this trade, what I want to see is I wanted to see this green bars happening. This is called a volatility expansion bars. So it just plots it in real time. It plots it as it was happening. Right? So here, especially when it's happening in multiples of bars, I know that this is probably going to continue. That means the trend is down, and these bars actually are expanded really fast. That means it's actually may continue type of thing, right? So here is another one. These are all just the explanation of what the expansion bars do. This is all again from 621, just the day before yesterday. Then when I'm looking for a patterns or something to happen, then I'm looking for confirmations of it. That means, I'm looking for this may have formed double bottom, I'm not sure. But if it is, then I'm saying this is how its expansion bars are telling me that this is it. You cannot trade the bars by themselves, because of that reason I'm looking for a pattern. But these are the ones kind of indications saying that there may be some positive momentum coming into the trade. Okay? So here is the one. Remember, you guys, the head and shoulder pattern I showed you how I traded it. This is on 6/19, and on that day, the night before, I was looking at it. This is one of the confirmations. This is an ABC pattern, ABC bearish. But look at the down bars. It's actually at the cluster of expansion bars was showing. So that was the reason the next day I was waiting for that trade to happen. I knew that this would happen. This is the head and shoulder. Although it went up, but it actually eventually fell to this point. So that's the reason I was looking for to say that, well, this is the down bars and it's forming, and there is a negative momentum built into it. That's the reason it may happen, and that's what happened for my trade. So again, hear it again. This is the trade actually. This is the head and shoulder pattern, but also ABC pattern. Again, this is from 6/19, 505 on that day itself. In fact, this is the day before I took the trade. So that's what I was marking, and I was waiting for this trade to happen. Here is the one how it completely evolved. I think we have seen this trade already. I just wanted to explain and show you, the big expansion bars, quantity expansion bars, how they came back and traded them. And also on the other side of it is when I'm trading ABCs, I'm also looking for the from my trade bars, I'm looking for these expansion bars happening right at that point. And so these are the bars being marked, and that one's showing it. So it adds some strength to it. As I said, you cannot trade by themselves, and that's how the trade actually resulted. This is maybe it's May 21st. Okay. And again, you can go back and see my archives, probably this year, last year, the year before. You can see every single day I post hundreds and hundreds of charts. And I have an archive of like thousands of these charts. I've been collecting it from 2000. And so every time I have it, I have like a lot of patterns, a lot of this theory. And this is what, this is my research. So I spend lots and lots of time in, of course, trading. Of course, this is my passion, and that's what I'll be doing. So how to trade a counter trend is one particular thing is if your trading experience is less than 3 years, I would say absolutely avoid it. Find all sorts of reasons to find avoiding the counter trend. Even if you have more than three years trades, trade only absolutely the best counter trend patterns, because this is the single most reason why traders lose money. Wait for some type of a positive moment or a pattern formation or something, showing for you to say that, okay, this is the reason I traded. Okay, if you have to trade a counter trend trade, think short term and be quick, really quickly in and out kind of trade, okay? And if a gap exists on that day, trade in the direction of gap, never trade against the gap. And even if you have lots of experience in the markets, we've been trading for a while, right now what I do is I think I limit my counter trend trades to less than 20%. Remember the first slide I was saying, the trader type, how I analyze is, have I taken trades beyond 20% of my overall trades in a counter trend? Then that tells me that I need to really control my counter trend trades, and if it's anything above it, obviously half of them will end up in a losses, sometimes they're big. Price must trade above fig band and show a retracement back to the ABC. That's how I trade ABC pattern. And I'll quickly show you one of the things which I posted. This is actually posted on my blog, tradechartpatterns.com. I actually detailedly posted. So one of the things is it's called a Hail Mary setup. That means it's almost like a desperate setup. Basically, there's an entire sell-off going on in the market. I haven't made a single trade. Then what I'm looking for it must be after 3 p.m. That means the market tend to reverse after 3 p.m. Not 100% of the time. At times it happens. So when I'm trading it and I'm looking for this, must be after 3 p.m. Okay, and must make sure the CMI is great. So once this pattern is made this type of trend, then I'm probably seeing some type of a CMI coming into it. Volatility is normal, because if volatility is above 50, you cannot trade it, I cannot trade it. So I'm actually waiting for this type of ABCs to form, and must have some type of a positive trend. So either it's slowing down, and now you know that okay, this is probably trade setup which you can take it. Okay, and I would say again, if you can avoid it, absolutely avoid even this trade also. So here is the trade setup. I think it's this is from the April 10th. April 10th here, if you look at the date here. And then you see this is the trade. And then once it came back into it, this is the ELA's one trade. And then the targets are up to like that. So this is how it actually reverses trend. But if you have to you get out before the 100% of AB is hit. That's how probably it ended up. And I just wrote briefly how do you trade after 3 p.m. The trade must happen after 3 p.m. only. 3 p.m. again East Coast time. That would be the end of my presentation, and what I wanted to show you, I'm sure some of you already know about my book. The book is primarily written for traders, and it has 65 patterns, and it specifically shows you, how to trade these, and not only what all I talked about here and a lot more. The CMI and the volatility, of course, they're not patterns, and in fact they were actually built after I wrote the book. So because of that, there's no explanation of it there, but you can go to my website. You can see lots of information. You can also send me an email. The book actually has about 65 patterns, and it has 225 charts, and it clearly explains how do you trade these patterns. The book is also translated into German. You can also buy the same German book if any German traders are there from my website. The book is 300 pages. It has like 8.5 by like 11 inches book. And it has got, as I said, 225 chart illustrations, and then it has got a specific targets and stuff. That's what we look for. That's what I look for. So my websites are surinotes.com, surinotes.de is for the German book, or you can actually buy the German book also from my own website. The discounts for the BMT members is, the book sells for $59.95 on my book. But if you go to that URL, surinotes.com/BMT, the book is $59.95. I'll give you a $10 discount to $49.95. And I'm also giving $100 discount to any of the ELD licenses. You can go and check my website and see if you're interested in any of them. And this is only for TradeStation, and it's valid until July 15th. You can actually buy any single indicator, for that $100 discount. I'll give it from there. And this is my website, surinotes.com, and I write tradechartpatterns.com. There's lots of great information I posted, lots of patterns how I write it. As I said, it's not quite regular, but every time I have it, I put a lot of effort into it, writing it. surinotes@gmail.com is my email. On TradeStation forums, my ID is Demicron. You probably can see me there because I'll be posting time to time. Not often, but if I have something to say, I'm probably posting there. And then that is the presentation. And then let's see. So we are done with the presentations, and we can actually take questions, or we can go into quiz, whichever way might be.
Okay. All right. So I'm looking at the questions here. Hang on.
Okay.
At one point, you were showing a screenshot of the DOM. That was a TradeStation DOM, right?
Yes, absolutely. Right.
Okay. Any plans to make your indicators available to NinjaTrader?
This is the constant question. I've been, I've been thinking about, building it for multi-charts. I've tried it. I also wanted to build it with a great friend of mine. He's absolutely a NinjaTrader developer, and I will be working with him to build some of these to both the NinjaTrader and multi-charts. It's been a long overdue, but I've been on multiple projects, and lots of course, issues with my families and all that because of that. But I will be working on it. Thank you.
All right, and a brief question. We'll try to keep it brief since we're running out of time, but what are your thoughts in general when it comes to auto trading?
I think auto trading is brilliant, but one thing I will say that if you are a discretionary trader, or let's say suppose you try discretionary trader and you haven't really mastered discretionary trader, then even if you're an auto trader, you will bring the same problems what you had with the discretionary trader to auto trading. So that's one point. Basically, if you're a bad discretionary trader, you will be a bad auto trader. Auto trading is not purely a solution. The only thing is it is automatic, and then if you can somehow master it, then you can probably get it and you can trade it. But I think, if you look at it, less than 5-10% of the people actually trade auto trader. The TradeStation has come a really long way. It's fantastic. Now the tools are really, really great. Up until 2008-9, there were a lot of issues. Now they're working through lots of course, NinjaTrader has it. Multi-charts also has the auto trading component, and a lot of TickQuest and some great tools. I think it's a lot of work. It's not an absolute solution for you to say that I can write some moving average crossover and create automatic patterns. But I think I will be actually heading in that direction too, because I know why I didn't build it before, but now I know why I want to build it because of the some of the patterns and some of the applications what I can do. Okay.
Okay. All right. So in the interest of time, I think that we should go ahead and just move to the quiz questions. So we are going to have 5 different questions, and we're going to give away 5 different autographed copies of Suri's book.
Fantastic. Thank you, Mike. Thanks again, and thanks for attending, guys. It's a Saturday evening. I know that it took more than 2 hours. I knew kind of that it will be an hour and a half to 2. But if you do have questions, and if you didn't get your answer, you see my email there. Please send it to me, and I will definitely attempt to send you an answer for whatever questions you have from my presentation. So what we'll do is we're just going to have 5 questions. Each question, of course, has an answer. So I want you to type in the answer so that way Mike can see it and probably read it. Mike, if you can help me, what I need to do to read the answers myself here. I have this GoToMeeting completely minimized. Anyone has some? Okay. So you're going to type and you're going to show it to me?
On the bottom, since I don't know what the answers are, you need to expand the panel that says questions. There's an icon on the right that says undock, and that way you can see as people type.
I think I need to work, because I haven't done that part of undocking. Okay, undock, I can undock it right now. Okay, it's undocked entire, oh no, this part, okay. Okay, I undocked it, but you know that the font is so tiny. Okay, I actually expanded it. Let's go ahead and let's go ahead and try this. Okay, I'm going to try it. I'm going to start to show my first question. Mike, can you see this?
Yeah, so question 1 is, where is the second resistance zone? Fib ratio is built into the Fibonacci zone pivots.
Mark, if there are any, Mike, any questions, any answers coming in the chat, I'm not seeing it.
You probably have undocked the wrong thing. It's labeled questions.
Oh, okay, hold on.
We've got about 20 or 30 answers so far.
Okay, questions. That's the one I need to undock, not the other one. Okay.
And you can leave that up because it doesn't show. Yeah. So I'm just looking for the first person.
It doesn't show, but I wanted to make sure, but I'm not even seeing one answer to it. Is it probably minimized? I cannot expand this.
Okay.
Oh, no, I got it.
Okay. On the GoToWebinar panel, you have something that says like dashboard, audio, chat, and then there's a section that says questions, and there's two icons. Right.
I got the question. I got the question undocked. It's there, but what I don't see is the answers.
Have you scrolled down? There's about 20 answers.
Okay. Yes, I see it now. Okay. I'm seeing the answers. It says, well, what I'm looking for it is, okay, the first answer is right. Is a John Bolanakis, I guess. Bolanakis, I'm sorry if I'm.
All right. So
he's the right answer. It's 138.
Okay. So 138.2, and John, if you would give us, John Mullinex, if I'm saying that correctly, give me your BMT username, please, and I'll be contacting all the winners once the webinar is done. I'll send you a private message on BMT, and then get with you, and we get your contact information over to Suri for the book. So John, just type in your BMT username, please. All right. So Suri, what was the right answer again?
It's a look at it, here I have the slide which shows the 138 to 162% of yesterday's range. So this is the second band. The first band is between 50 to 62, and above is 138 to 162. So that's a resistance band. So that's what we are looking for. Okay.
Okay, we're ready for question 2.
Second question.
All right. So
okay,
today
this is the one which is the kind of you guys. Okay, today ES opened 8.5 points higher. I actually have a chart to show, so first I wanted you guys to read it from yesterday's close. And now at 12:45 p.m., ES is trading near 50% of the gap level with a normal volatility, right? And you're also seeing a small ABC bearish pattern, right, emerging. So how would you trade this? So I will actually show you a chart, and then we wanted to see if you can. So this is the chart. If you look at it, it gapped up, and this is from a gap fibs tool. It actually shows a gap of a 8.5 points, and then right from the gap, now it started falling. It traded at 62, but now it's showing that it went up there, and then now we are seeing an ABC bearish pattern kind of, and here we are at 12:45 time frame here, okay, and the gap is almost near at 50% of it. So how would you trade this? Okay, trading the, okay. Actually, I do like all the answers, which is that means that I've done my job of telling you not to trade against the gap. So that's I think the first answer, which is close to right, is okay. I'm going to go back and read this. The first person is Eugene Grisham. Okay, Eugene Grisham, he answered it right. Mike,
Okay.
that's awesome.
All right, so Eugene,
Okay.
could you give us your BMT username, please? And so sorry, what was the?
Let me actually let me show you why it is here. Right, this is what happened. This is the ESD. It's I forgot when it is. It's on February, I think. So what happened was here you're farming and you're thinking that this is an ABC bearish pattern. But look at what is the compelling reason to not to trade against the gap. The gap is pretty big gap, right? 8 points. Actually, anything above 6 points, like 5-6 points is big gaps. So, and after that, of course, it went up. So do not trade, patterns or anything which are not agreeing with the gap. So that's the one. That's the way to trade it. Okay. Good job, Eugene. Let me go to the next question. Question number 3 is. Okay, look at this chart. Find all patterns and trades. How would you trade this? This is actually one of the prominent chart in our company. I actually will tell you in a second what company it is. This is, yeah, it is a weekly chart. This is actually a weekly chart. And then if you guys can tell me there are 3 patterns. What are the patterns in this one? And I'm looking for the pattern names. Don't forget about the trade. How do you trade it? I'll show you how. But just tell me the pattern.
So we're looking for 3 answers. So I need everyone to type in 3 answers. Okay, 3 answers on one line. So before you press enter, you should have 3 answers. Okay.
Okay, I think we got an answer. Pretty close, but I think I'll pick one name. Mike, her name is I think Melissa Sobi.
Okay.
Sorry, Melissa, if I pronounce your name wrong.
Yeah. So Melissa,
okay. I think she's right.
Give us your BMT username, please. And I also I forgot to mention that's only one winner. You can only win 1 book. Okay. So if you've already won a book, then don't answer any further questions, please. All right, so Melissa, give us your BMT username, and Suri, could you repeat the answer for everybody, please?
Yes, I'll actually slide to show you, okay? So look at it, right? In fact, what Melissa did is right. It's basically, it's like this is a double top, and there's a symmetric triangle, and this is the Microsoft. In fact, Microsoft actually broke out in December. Actually, I was in this trade, and the target was $32, and this is an ABC pattern. It's also symmetric, and it has a double top. Of course, the trend prior to that is also like an upside. Usually, the symmetric triangles break out. So now, of course, now it's came back and tested this 29 level, 100 level, and now it's kind of rising from here. We'll see where it goes. But this is actually a weekly chart of Microsoft. Okay, this is another tricky question, guys. Read this. Okay, you are running a serious HFT, which is a high frequency trading algorithm or program, which is doubling your money every minute. I know this is not what I taught today, but let's just suppose you have a program which is doubling your money. If you made more than $1 million in 20 minutes, right? When did you make at least $250,000? I think we got an answer. Let me see the answers, what our people are coming out with. I think the first great answer came is Vance Hoshizaki.
Okay.
Vance Hoshizaki, 18 minutes.
And I need your BMT username, please, Vance.
Okay. Okay. The question is basically, you're doubling your money every minute. So you made $1 million at 20th minute. So the answer is 18 minutes because if you made $1 million in 20 minutes, 19th minute you had $500,000. And the previous minute you had at least $250,000. So that's the right answer. Okay? Instead of you guys going and actually looking at the math or 2 minutes, or I've seen quite a few answers like 40 minutes. Well, if you made $1 million in 20 minutes, you will make $40 million. That number is astronomical. It's probably like a 18-digit number. So anyway, thanks for the answers, guys. That's the question 4. The last question is, If you have at least 3 years of trading experience, how do you place a long trade in a serious market sell-off? I'm looking for an answer. Okay, that's it. I think I got an answer. Thanks. This is the Bruce. Oops, I think his name ran off already. I need to pick this also right. Bruce Register.
Okay, Bruce, I need your BMT username, please. And what was the answer, sir?
Yes, the answer is what we do is basically when it's a market sell-off. I was saying, if you have, even you, if you have more than 3 years, also you should avoid this kind of trading. But you only trade long after 3 p.m. First of all, and that you didn't say, but that's okay. And the second is it needs to touch the mid-fib band and market internal showing, and then it's giving you an ABC pattern. It usually is a small trade and make it as a really quick trade. That means it's absolutely going to scalp, so just take 1 or 2 points and run. That's the answer.
Okay. All right, guys. So congratulations to the 5 winners of the autographed books. I will send you a private message after the webinar ends. I'll gather all your contact information and send it over to Suri so he can get those books out to you. Suri, do you want to throw up a slide one more time with your contact information should anyone have any further questions and they want to get a hold of you?
Absolutely. Thank you, guys. Thank you for this opportunity for me to present it to you. My website is surinotes.com, tradechartpatterns.com, and surinotes@gmail.com is my email. As I said, TS Forums on the Trade Station Forum, Demicron is my ID. Please send me any questions, and I'll definitely try to answer it back. Again, thank you very much. Thanks again, BMT and Big Mike, for the 3rd-year anniversary, and it's fantastic, and this is a great opportunity for me. Thanks again, Mike. I guess if I have any questions, I'll take it now. Otherwise, I'll be out.
Okay. Yeah. If you guys have questions, then due to time, I'm going to just ask them to send you an email. So once again, thank you, Suri, for being on here for the 3rd time. And I'll see everybody. Yeah, I'll see everybody on the forum. I'll post the recording for this webinar probably sometime tomorrow. All right. Thank you, guys.
Absolutely. Thank you, guys. I'm going to take off. Bye now.